Into next year.
Chris Whalen's one volume on our financial history shows there's haves and have-nots. The haves are loving this. There's a lot of people that are not.
Jeremy Stretch on the FX market coming up with two big central bank decisions a month or so away.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
These strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages. So even if we saw softer jobs numbers, it could be because of strike effects. It could just be because we are in a tight labor market. We're running out of people to hire. Labor supply is still an issue here.
The reminder from Veronica Clark and the team at Citi that this is still a tight labour market. We have made progress, though, and off the back of that progress, a big move in the stock market yesterday, the biggest one-day pop on the S&P 500 since June. The market right now pulling back just a touch. We're down 0.1%, just about on the S&P. In the bond market, tremendous rally yesterday, particularly at the front end of the curve. Yields lower, Treasuries up this morning. Treasuries down, yields higher by 3 basis points, 4.1472 on a 10-year. Steve Englander of Standard Chartered just publishing moments ago on the jobs openings data, so-called JOLTS data from yesterday, giving the Fed what it wished for, TK. The drop in job openings gives the Fed evidence of a softening labour market. We get ADP a little bit later, claims tomorrow, payrolls on Friday.
Let me review it quickly here. The mathiness, John, of this is you take the vector of the JOLTS survey, and from the peak of the standard deviation, we've gone from +2 to minus 1.3, so that's a combined 3.3 standard deviation move. Maybe in a month, maybe in 2 months, if this trend continues, you've got a huge seismic breakthrough in JOLTS that indicates that softening market.
Englander goes 1 or 2 steps further, Tom. He says, we also think that JOLTS may be overweighting new hires and underweighting job losses. Goes on to say that job openings may be revised down further as we think new hires are overstated. This is a point that Steve's made repeatedly, TK, so he's in that camp. But curious going into payrolls on Friday.
It'll be interesting to see. Sonia Ward and Yana Randall at Bloomberg did an article the other day on German inflation, the memory, the history that the Germans carry. And the photograph was stunning from 1922, where boys are playing with a kite, and they've made the kite out of depreciated, devalued Deutsche Marks. Jeremy Stretch has never made a kite out of the British pound, but he joins us now, head of G10 FX strategy at CIBC.
Good morning, Tom.
Jeremy, the culture is there of a worry of inflation. In Europe, is it tangible? Do you take it back to World War II and frankly beyond? Or have we gone past that to a more rational discussion?
Well, I think you have to remember that the history of Germany is very much characterized by the hyperinflation of the 1920s, and that did characterize monetary policy for a considerable period through the Bundesbank era and ultimately carrying the Bundesbank into the ECB. So there is that recognition and realization that inflationary pressures are an obvious and ongoing long-term historical threat and negative narrative. So that's been one of the reasons why the Germanic members of the ECB are always very much focused on that sort of inflationary vector and really pushing back against that in a very aggressive bias. So I think that really leaves the ECB obviously in an increasingly large policy conundrum, as Madame Lagarde has to deal with that Germanic core who are very keen to maintain monetary policy tightening, whilst, of course, the Doves, and Centeno has been amplifying some of the concerns this morning, whilst the Doves are detailing some of the weakness that we're seeing in terms of the real economy data, the downside risks that are starting to materialize in the ECB's most recent forecast profile. And so that leaves the ECB in an increasingly difficult challenge. And I think that really ups the ante and the onus on tomorrow's CPI report.
But off of Lagarde's speech at Jackson Hole, and frankly her speech in New York in April, where she talked about getting the capital markets organized in Europe, does the ECB have the tools to actually commit monetary policy?
Well, of course, this is one of the longer-term considerations and pitfalls, in a sense, of the monetary union process, because, of course, we have seen a situation which is not necessarily compatible with the sort of the broader remit of having a coordinated monetary policy. We don't have that unified fiscal backdrop, and we don't have that unified or singular bond market. So the tools at the disposal of the ECB are somewhat dispersed. We do and have seen the ECB being very creative in its policy toolkits over the course of the last decade or so, when it has been forced or brought forward in order to bring forward some fairly aggressive measures. But the ECB is finding it, or will find it, increasingly a difficult challenge as it aims to moderate and pare back its balance sheet and deal with the differential economic and particularly inflationary dynamics across the zone.
Jeremy, the same people who were talking at 115, 120 on the euro a couple of months ago, a couple of months later are talking down to 105 on euro dollar now. Where are you on the single currency, on that currency pair?
Well, I think in the short term, we are still going to have further headwinds. So I wouldn't be surprised if we do have a retreat back to nearer the 105 threshold. I wouldn't necessarily expect that level to give way, but I think it's quite conceivable that we could head back towards the sort of 106 earlier year lows. I think the terminal rate in the Eurozone is more likely to be 3.75 than 4 at this particular juncture. But of course, that could well change if core CPI proves to be remarkably resilient tomorrow, although I think core inflationary pressures are going to moderate and base effects are quite significant in the August and September prints. But I think once we see that sort of trough reached, and I think that also is requisite in terms of the dollar getting some resilience from the policy backdrop and in terms of the macro momentum, then I think if we do see that sort of 105, 106 threshold tested, I think we can look at that as a base, and the weakness that we're seeing in the Eurozone economy doesn't warrant further cheapening up in the euro, and I don't think we're going to be back into the narrative of talking about parity as we go through in the latter stages of the year.
Jeremy, can I just pick up on that dollar resilience point, especially in light of the data we've gotten in the last 24 hours that would suggest that we are starting to see some of the deterioration in consumer sentiment in labor markets that in theory the Fed would like to see, and the thinking now being that maybe they won't have to go again and maybe they start cutting earlier. How does that feed into a stronger dollar story?
Well, you're absolutely right. We have seen a degree of loosening in the data, and I was listening to John earlier talking about the job openings to unemployment ratio, that's come down from that 2 level down to around 1.5. But that, of course, is still above the pre-pandemic level of around 1.2. So there is still further work to do. We're in a easing labour market environment, but we're not one which is necessarily loose. And I think we still have to remember that wage growth is still remaining relatively sizable. So I think it's too early to suggest that the Fed have desisted from policy tightening, and we still have one final Fed hike in our forecast profile. But we wouldn't necessarily also anticipate that the Fed will be very keen to look towards easing policy very aggressively early in 2024. And I think the legacy of the Volcker era and the early adjustment of policy, which proved to be a policy failure, I think is something which the Fed would be very keen not to repeat.
The narrative can change again quickly on Friday. Jeremy Stretch, thank you, sir, of CIVC. On Friday, a payrolls report, 170,000 is the median estimate in our survey. An ADP report a little bit later, considered to be the appetizer for the main course later on this week. 195,000 is the estimate so far, Tom. The previous figure, 324. If you want jobless claims tomorrow, 230 currently, 235 the estimate. And we want to see further signs of progress like we did yesterday.
We've got a great screen on the terminal. Really, it's one of the reasons people buy the Bloomberg terminal is the ECO screen. And what I notice is the shock that we had 30 days ago, those big high numbers, and people are once again modeling in a slowdown. Why is this different than 30 days ago?
170 feels a little bit more normal. Then, Tom, let's not forget, September 13th, got a CPI report right before that Federal Reserve meeting a week later. But so there's still some stuff here we need to get through before we call it quits on the next move from the Federal Reserve.
Well, I think there's a lot to get through this week before we call it quits. You won't be in on Friday, but what I would point out is I'm sorry, we're right back where we were 30 days ago. We got this cautious view. The numbers are coming in, boom, and they come in better. I mean, that's been the American way for 18 months.
I think the point, though, that Jeremy made just now was really interesting. The idea that there is a difference between easing and actually loose, a difference between progress and arriving where you want to be. And that's going to be the story going forward. Does it develop a pattern? Is there consistent signs of things moving in a trajectory that is going to give the Federal Reserve confidence that their work is done?
We're on a journey. And we're not at the destination yet.
There we go.
Is that okay? Yeah?
Yeah.
Okay, good.
A journey in cloudy skies with stars and...
Yeah, you got to bring the stars in. With Powell, starry, starry night.
You're going to sing for us. Why don't you take a vacation? That's
I need a vacation.
Why don't you take a day off?
Mike called me up yesterday. He said, take a vacation.
Take a day off.
John, Monza this weekend. I mean, I assume you're flying over to Monza. That's why you're not in Friday.
I wish.
It's like a really old course. I mean, are the cars too big for Monza?
No, they've made a lot of improvements.
Is it like James Garner at Monte Carlo? It's like wicked narrow?
Not quite. But Ferrari are in a world of trouble, Tom. They've got to fix this.
They like have to. It's the mother country. They got to win it.
You're talking about being maybe finishing 4th or 5th in the Constructors' Championship, which is just
Is it
shocking.
engineering? It's just Red Bull's out engineering?
Strategy, aero,
I know
everything.
What I'm talking about.
Everything.
Aston Martin is green. Thank you.
If Ferrari had Red Bull's car, they'd still screw it up based on what I've seen, okay?
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Everyone's still data dependent, and everyone's still basically concerned. We really don't know where we're going.
I think the trend in global rates is still up.
I think everyone's been surprised that we've been so resilient up until this point.
I think we're in a pause period now, but I suspect we'll have a strong fourth quarter.
The bar for a rate hike in September, I think, is pretty high.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Jobs Week in America, not Jobs Day. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with Katie Lyons. Your equity market just about negative on the S&P 500, down after a big one-day pop on the S&P and the Nasdaq in yesterday's session. Tom, off the back of job openings data, ADP a little bit later, claims tomorrow, payrolls on Friday.
Well, we're going to see what the payrolls are. And again, I'm going to say it's a wage report. It's going to be interesting to see for the Fed and for what it means for equity markets, what the wage dynamic is, much more than the actual non-farm payrolls number. And that's where the JOLT survey came in yesterday, where it jolted the market. Can we state the VIX under 15? I think that's a bull market, 14.57.
It was a big move, the biggest move since June on the S&P, since May
jolt
on the Nasdaq. That jolt, some fuel for the Fed doves on September 20th. That data this morning, Katie Lyons, some fuel for the ECB hawks on September 14th.
Yeah, in Spain, in certain German states, we're of course looking out for German economic inflation data. West Rhine-Westphalia, yes.
Nailed that.
Higher inflation than expected speaks to the still persistent underlying inflationary pressure in the Eurozone that the ECB is going to have to be paying attention to. And of course, we get the full euro area print tomorrow. That is going to inform what they do in September, since of course Christine Lagarde has not pre-committed either way.
Do the algebra, Kaylee. I know you nailed it at UVA in advanced algebra. And the answer here is we have a positive real rate. Europe has a negative real rate. Nothing else needs to be said.
President Lagarde, work to do. Did you get any indication whatsoever from the 10-minute conversation you had with the ECB chief of which way she's leaning, Tom?
Well, we talked about Paris and off camera, the boom in tourism in Paris, what it means. We talked about, you know, the beautiful summer. She's taken like 12 weeks off, you know, the usual holidays.
Is this a long way of saying no?
Yeah, we didn't talk about it. No, you know, the way this sets up, and a lot of people said, why aren't you asking her about September 14th? First of all, through the whole interview, I said September 16th with my charm. But the bottom line is you have an agreement before, particularly, John, at academic conferences. Different rules are under play. It was a different interview than your rude and mean interview you would have had.
Are you describing my interviews as rude and mean? Is that what you're describing?
When I first met John, he's over at Frankfurt being rude and mean. I'm like, who is this guy? These are tough questions to Trichet.
ATK, I think a lot of people might agree with that characterization of my interviews. I want to stay on top of this story. It's a serious one, and we'll get feedback from the team throughout today on it. Hurricane Idalia strengthening to a Category 4 storm. The latest update from the U.S. National Hurricane Center a little bit early this morning, in the last few hours, Tom. Winds reaching 130 miles per hour. Big stuff.
Yeah, Rob Carolyn categorized this back to 1989 and Hugo with an asterisk, in that it's a smaller storm, not like the shock we saw in New Orleans years ago. Smaller storm with tropical winds outside on the edge of the hurricane, but near the eye, this can be vicious.
And the damage from the water, Kaylee, we often talk about this. It's not just about the winds, it's about the water damage that comes with it. 16 feet of seawater could be pushed on shore north of Tampa.
Yeah, the storm surge could be potentially catastrophic as well. And of course, when you're talking about a storm that is bringing heavy rain and water that could move across the state, it's talking about flood risks as well, not just the idea of hurricane force wind damage. And it speaks to the insurance gap issue and just the consequence of living in these areas that are increasingly being pounded by natural disasters.
Got a phone call this morning. Riley from St. Louis down there. She's very, there's like a thing on the edge of the water over on radio over in the distance across the bridge and the big waves. There's a wall. Riley's there with her waders on doing the whole, CNN hurricane thing.
And leaning into the wind.
And she said it's just another hurricane for Florida. I mean, Riley's, she's been through like 47.
Do you know how much I despise that?
What?
The weather porn. Going in there and sort of leaning into the wind. This is really, really dangerous stuff. This is really dangerous stuff.
It makes light of it. I strongly support your thoughts.
It is not entertainment.
I've never done it. I've been asked to do it, but I've never
done it either. I have very little interest in doing it.
Yeah.
It is highly, highly dangerous stuff.
Riley's, she's making a penny, or she's going to end up at Burns Steakhouse afterwards, chowing down a steak.
I'm not sure where you're going with this.
Okay.
Here's the price action on the S&P. We're negative here by 0.1% on the S&P 500. A little bit softer, lower after a big day of gains in yesterday's session. Yields here, Katie, a little bit higher by 3 basis points on a 10-year after a big move lower in yesterday's session.
Yeah, fueled by the economic data. So will we see another move off the economic data? We have yet to get this morning. 8:15 a.m. Eastern time is when we get the ADP print for August. Remember, in July, the number was 324,000, much stronger than expected, then quickly followed by a softer than expected non-farm payrolls report. So how seriously do we take the numbers today? 195,000 is the print we're looking for. Then at 8:30 a.m. Eastern time, another slew of economic data coming. Personal consumption is one of the figures we're getting, as well as the second print of second quarter GDP. We're expecting it to remain unchanged at 2.4%. But what does consumption and consumer power really look like in this economy at this point, as we saw a softening in confidence data yesterday? Then finally, 10 a.m. Eastern time, pending home sales. Interesting to contrast this potentially with the headline that just crossed the Bloomberg on mortgage applications. Actually rose 2.3% last week, even as we're looking at rates well north of 7%, 7.5%, what we're actually looking at here. So what is the impact ultimately, especially in the existing home market that is still incredibly low in terms of inventory, no one wanting to let go of the mortgages they have? How does that factor in to pending home sales?
Katie, thank you for the update. Joining us now is Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Margie, big day of gains yesterday. Are you still constructive on this equity market in America?
Yes, I think we'll have a strong finish to the year, maybe more moderate returns than we've had year to date, but still a positive return because the economy is still pretty strong.
Margie, I look at where we are on free cash flow. In the heart of the matter is there's a generation of people that don't know the rate structure we're in right now. You and I have lived it. Can corporations generate free cash flow and dividend growth from it in this interest rate environment?
Oh, yes, because I think interest rates is just a small part of their costs. If you look at companies since the financial crisis, they have restructured their balance sheet, locked up fixed rate, low rate money. And so I think they're really rather impervious to these increases in rates. I think that's one of the things that's fuzzled the Fed. But I expect they'll continue to maintain profit margins.
I like the idea of impervious as well. If I'm a CFO, how do I change my issuance given this high environment? Do I extend out duration? Do I stay short? What do CFOs actually do in a real rate environment?
Well, I think most of them have already done that. For the last 5 years, particularly in the high yield market, we've seen more than half of all the issuance being to extend maturities, pay off bank debt, refund or pre-refund issues coming due in the next couple of years, a so-called maturity wall. So I think most companies really don't have the need to borrow new money. They have enough liquidity on their books to handle their own needs.
Well, when we talk about the companies and their borrowing needs and just their financial position, Margie, what is the default cycle actually going to look like when they, to this point, have remained incredibly low? There is growing calls for a soft landing. You seem to think that everything is still looking relatively strong here. Does that mean that there's not that much risk in riskier debt?
I think particularly in the public high yield market in the U.S., that market is going to continue to have very, very low default rates. Right now, the default rate in the U.S. is a little over 3%. In the loan market, it's higher. It's over 3.5% because a lot of the poorer quality issues finance there rather than the high yield market. But as I said, most high yield companies were very prudent in the last decade, and they simply extended maturity and they've improved their balance sheet. And so the quality of the high yield market is good, and I think defaults will stay low. That's why yield spreads have stayed pretty narrow.
Margaret, isn't there a day of reckoning next year if this Federal Reserve isn't cutting interest rates? For those companies that pushed out that maturity wall, termed out their debt, don't they have to start reissuing in 2024?
I think most companies have a couple years before they have to worry about liquidity. So I don't think there's a real risk that companies aren't going to be able to refinance. And once again, is there access to money rather than the cost of money? I think at the margin, not that many corporations are going to need net new money because of maturities in the next year.
With that in mind, if higher interest rates aren't going to bite corporates in America anytime soon, doesn't that just extend the cycle, Margie, and keep rates high for even longer potentially?
Well, I think it keeps the economic cycle going, and really, I think the puzzlement has been, where's the recession? And there's no recession in sight because everything in the economy in the U.S. is really pretty well balanced. People aren't affected by this big increase in short rates. And really, right now, the 10-year is, 4.25? Maybe you'll drift up to 4.5. Those aren't exactly the sort of rates that choke off economic growth.
So if I've got a nice pool of cash right now, should I be worried about the reinvestment risk down the road, or should I just sit there in a 2-year in T-bills and relax and know that rates are going to be there next time I need to reinvest that money?
Well, I think it's likely that we'll see short rate, well, certainly much higher than they've been for the last decade of near zero. So yes, I think there'll be much more of a return for investors short-term oriented. But really, if you say the yield is, say, 5.25, something like that in risk-free assets, and the cash flow yield of corporations is maybe 5.5, 5.75, that says to me you're better off taking the volatility and looking at equities or high-yield bonds, which have a lot more to offer than short-term risk-free assets.
Margie, thank you. Margie Patel of Allspring Global Investments. On where to put your cash right now, TK? Well,
you're in cash right now because you're loaded up for your conventional 8,000 shares of ARM, right?
Is that what I'm doing?
Yeah, I mean, you know everybody in the city. You've made the
What was that
calls.
shoe? What was the Birkenstocks? I'm waiting for that.
Yeah.
When is that
Are they going public too? I did not know this.
So. Sort of laying the groundwork for that to happen.
The ARM IPO, I mean, it harkens back to a time where I actually did this on Wall Street. I guess I believe there's some interest in it. They're actually going to pull it off.
It's a pretty unique IPO given the history of the company.
Agree.
It's not like some new start-up that's been around in private markets
speed on
for a
us,
couple of
Kaylee,
years.
help us here. Neither of us know what we're talking about. What a shock.
I mean, obviously, it would be a massive one, but to John's point, this one is a little bit of a unique situation. I think, is it a sign of revival in the IPO market? Maybe this one not so much, though Instacart, potentially. I think
well,
that's
this company, just for the record, I used to cover this company when it was listed in London. Yeah, used to do the quarterly earnings reports, used to catch up with the CEO, Simon Segars.
But now this is about Japan and SoftBank, right?
Precisely.
Yeah. Right.
Bought the company and now taking it public.
So what's the Instacart story?
It's going to go public. We've been waiting a long time to see a revival in companies re-entering public markets.
Is Instacart groceries, or is it like Uber Eats, like food?
Like both.
You've not used that before?
No,
Let's move on. This conversation's dead. Okay.
It's our IPO discussion. We're sophisticated.
The latest update from the U.S. National Hurricane Center. A couple of hours ago, we were told that Hurricane Idalia strengthened into a Category 4 storm. The latest information I can bring to you is that it's been downgraded to a Category 3 storm, according to the National Hurricane Center. Much more on that in just a moment. If you're just joining the program, welcome. Your S&P 500 negative by 0.1%. In the bond market, Tom, yields higher by 3 basis points, 4.1530, and tons of economic data this morning and through the rest of this week still to come.
Let's look at some other things we haven't touched on today as well. I'd look at Brent crude with an 86 print moments ago, 85.94. Really watching that towards a $90 a barrel. We're not there yet, but I just think it's on my radar. Swiss franc hasn't given me any angst here. It's fear-free on a recent basis, and the yen 146.38. John pulls away from that weak yen 147. Maybe a more constructive global tone around the jolt shock yesterday.
Please, you mentioned crude, Tom. On the month, equities down, but energy equities just about positive on the S&P 500 for the month of August, and that TK with all of these slowdown fears.
They won't come back.
All of these slowdown fears taking place over in China, and there you go, just a little bit of a nudge higher.
I sort of equate the non-pullback in energy as I do with the spread market. Bramo's like way more up to speed on that than I am, but spreads haven't pulled back. I mean, that's all there is to it, and this is maybe the market telling us that we're going to get to a constructive place down the road.
Well, Tom, you mentioned it, iron ore. The signal you take from what's happening there.
They're in my ear.
I
don't have a clue.
China.
They're in my ear. They're like iron ore.
Got noise?
They're like
What's
Singapore.
happening?
Singapore iron ore.
Okay.
Mention Singapore iron ore. Okay.
People tell you what to say.
Oh, yeah.
Do they?
All the time.
I don't get that voice.
Yeah, I got 2 interns.
You get supervised by
I got
interns.
interns. Yeah, one's from UNC and one's from Duke.
This explains a lot sometimes.
It does.
Peter Cheer of Academy in the next hour from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I hear about, unfairness, arbitrary decisions, a lack of due process, raids on their businesses that go unexplained, tens of millions of dollars in fines for reasons that aren't clear. And so my point is that action speaks louder than words. And as long as that is happening on the ground, that makes it very risky for U.S. businesses to do business here.
Commerce Secretary Gina Raimondo speaking in Shanghai. Day 3 of her trip. It will go to day 4 tomorrow. Tom, those comments happening at the same time that we're reporting here at Bloomberg that China could be hosting Russian President Vladimir Putin in his first foreign trip since a warrant for his arrest on alleged war crimes issued by the International Criminal Court.
I was surprised by it. I saw the headline yesterday, and Bloomberg had that breaking news, and of course we've seen the 3-day on to 4-day soiree of the Secretary of Commerce. But I agree that it seems like we're pushing this in an agenda that Anne Marie can explain. But far more than that, I don't get what the response is. What are we looking for in terms of response by the good team over in Team Beijing? I don't know. Why don't you bring in Anne Marie, because you're more up to speed on this than I am.
AMH, our chief Washington correspondent, joins us in D.C. right now. Anne Marie, walk us through this. How do you balance this act? The administration is sending over high-ranking officials from the U.S. to China, a country which we're reporting is going to host a leader of a country facing alleged war crimes at the invitation of the Chinese president. AMH, how do you balance those two things?
Well, it's difficult for the administration, right? And Karine Jean-Pierre, the president's press secretary, was asked about this yesterday. She says she's not going to get ahead of a comment on a potential visit by Putin going over to China. What we're reporting is that Putin will make that trip for the Belt and Road Forum that's taking place in October. I'm not particularly surprised that Putin is deciding to leave for the first time since the International Criminal Court has slapped this arrest warrant on him for alleged war crimes, that he's going to China. People speaking to Bloomberg have said Putin wants to make sure he's very safe in the country he decides to visit. Remember, he had to shrug off the BRICS in South Africa. He told Modi he won't be attending the G20. So China looks like a safe place for him to go. Also, remember, just about 3 weeks before Putin decided to invade Ukraine, what we had was his last meeting with Xi Jinping, where they decided to have a new no-limits friendship. I went back yesterday and reread through that readout from the Russian ministry, and they talked about there's really no area that could be forbidden in this relationship with these two countries. We've also seen Xi Jinping go to Russia. So this is a friendship that's only going to tighten him, but it's definitely going to be incredibly awkward for the administration, and it's very awkward for Secretary Raimondo, who was actually in China yesterday when we broke this story.
I mean, Anne-Marie, the whole thing is bizarre. If President Trump wins or another Republican wins in November, how does our relationship with China change? I don't see much difference other than maybe you'd get a Biden theater response different from a Trump theater response. They're both on the same page, right?
Well, there's a lot of optics and there's a lot of bashing of how each party handles China. Basically, it's who can out-hawk the next one. And that is why the rhetoric is really going to be ramped up before the November 2024 presidential election. But you'd be hard-pressed to find anyone in Washington that doesn't want to take a tough stance on China. And honestly, even if they didn't want to, politically, they cannot. Politically, they must show that they want to be tough on China and hostile towards China. At the same time, the global community and economies around the world want to make sure these are the largest economies, the United States and China, have a working dialogue. And I think that is why what you see the Biden administration or any president, whether Republican or Democrat, is going to have to balance.
Yeah, and we continually hear from the administration, Anne-Marie, for all the hawkish rhetoric that is out there, that the U.S.'s aim is not to hold China back economically, that this is just protecting national security interests. That is what they are trying to accomplish. But we were speaking with Leslie Benjamin of Chatham House earlier on in the show. She was talking about how China pays attention to people like Chair Mike Gallagher of the China Select Committee in the House, some of the language that he uses. The administration is not the only voice here, especially when you also have 2024 Republican candidates in the picture as well. How does that complicate the administration's efforts?
Well, they can't control, right, what Republicans are saying. I mean, heck, they couldn't control their own Democratic Speaker of the House, Nancy Pelosi, going over to Taiwan, which really was the start of a domino effect of growing tensions between Beijing and Washington. So there's not a lot the Biden administration can control in terms of that rhetoric. What they can do is just try to keep these paths of dialogue open, whether it's Raimondo and her counterpart or Yellen and her counterpart, Secretary of State Antony Blinken and Wang Yi. That's what they are trying to do. And of course, all of this potentially could culminate to a meeting between Biden and Xi Jinping, another meeting. There's really only 2 more moments left for the rest of the year for those two individuals to meet, because next year it is going to be full-on campaign mode.
And Anne-Marie, of course, in Washington, there's always a split focus on what's going on abroad in places like China and what is going on at home in places like today, Florida, where within this hour we are expecting Hurricane Idalia to make landfall in Florida. I know you spoke with Senator Rick Scott of that state yesterday. It raises the specter once again of the conversation around disaster relief. It really started with the fires in Maui just several weeks ago. Now, when it comes to the hurricane as well, and supplemental funding. Do disasters like this make it easier for the White House to actually get that ask granted by Congress?
It does make it easier, but the problem is the supplemental funding that the White House has asked Congress also includes aid to Ukraine. And this also has many Republicans in Congress, some of them infuriated. They do not want these two items attached. But we should note, FEMA is in dire need of this funding. Of course, the federal government is going to spend whatever is needed for these disasters. At the same time, they're going to have a deficit, and they're going to have to replenish the disaster relief fund. As of yesterday, the FEMA administrator said the disaster relief fund was at $3.4 billion. Obviously, that is not enough money considering the natural disaster this country is facing. So Republicans are going to have to, or the fight that's really going to happen when the House and the Senate comes back in early September is going to be whether or not they are going to okay a supplemental that has a number of other items attached, but does also include money for disaster relief.
MH, thank you. Anne-Marie, down in Washington. The latest on that hurricane. Reporting coming from the National Hurricane Center, the most recent update from about 23 minutes ago, weakening slightly to a Category 3 storm as it makes landfall in Florida. A little bit later this morning, Tom, we had a quote from the Hurricane Center earlier on this morning in an update about an hour ago. Said this: while Idalia should weaken after landfall, it is likely to still be a hurricane while moving across southern Georgia and near the coast of Georgia or southern South Carolina later on today. So, Tom, makes landfall a little bit later this morning and then starts to make its way up the coast.
For our international audience, the focus on this in America goes back, I'd say, in the modern age to Katrina in New Orleans, John. And there was a real feeling that it was not handled correctly by a broad set of politicians. And, you know, there's a whole political history on this we don't need to get into. But the answer is, John, you know, I don't know what it's like in Europe. Like if there's a typhoon, I mean, you're out there in Cornwall and you're in the surf with Poldark looking at the typhoons off the northwest edge. But the answer is, the politics of this goes back to Katrina, where we need to really be on top of the story.
Yeah, well, and that was the conversation we were all having in Washington in regard to Maui and how long it took the president to actually address this, to make an actual trip there, the optics of it, certainly. But this also, while it obviously is human, it is about the humanitarian impact, the impact it has on individuals' lives. There are economic consequences to storms like these as well. Just last year, when Hurricane Ian hit Florida, it cost $112 billion in damages. The thinking goes, because of where this storm is going to make landfall north of Tampa, that it may not be as catastrophic, but still, that doesn't mean it's not without consequence.
So you have a beach house and it's half insured, or a quarter, I don't know what the ratios are now. And then, John, I think you mentioned it earlier, or there's no insurance and people keep building, even if there's no insurance.
This is what Rob Carradine, our meteorologist, talked about.
Same out west of the fires.
So long as these things can be insured, Tom, they'll keep building them.
Yeah. I mean, it's been a boom, and we go through it. I don't know. I've read that we're going to have more hurricanes this year. I mean, it's only August. I mean, it goes through the season, I believe, goes through February. So
it is early. The latest update then from the National Hurricane Center: the storm, the hurricane, weakening to a Category 3 hurricane as it approaches Florida from Category 4 a little bit earlier. Coming up next, Ian Lingen of BMO Capital Markets on a Treasury market rally yesterday, inspired, fueled, driven by job openings pulling back aggressively more than expected. From New York City, good morning.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this.
I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
Equities on the S&P 500, really decent day of gains yesterday. Biggest one-day pop, one-day rally going back to June on the S&P. On the Nasdaq, going all the way back to May. Right now, we're negative 0.1% on the Nasdaq 100. On the S&P, we're down by 0.06. Just pulling back a touch, encouraged by the data we got yesterday, just showing further signs of progress for the Federal Reserve in the labour market ahead of payrolls on Friday. And, of course, that Fed meeting on September 20th. That meant equities up, treasuries were down. Tom, or rather, they were up too. Yields were down, to be precise. Yields are up this morning by 3 basis points, 4.15 on a 10-year, but a big Treasury market rally yesterday, particularly at the front end on a 2-year. After closing above 5% on a 2-year yield for 6 consecutive sessions, we pulled back TK aggressively in yesterday's trading session.
Let's frame that as price up, yield down, and the real yield framing out up to 2% at 1.92%. The 10-year real yield now 1.86%. Was it a jump condition? I'm not going to go that far, but certainly it was more than a nudge.
Stocks up, yields down. The story this morning, yields higher, stocks down. In the FX market, the euro looks a little something like this. The euro just a bit stronger after data out a little bit earlier. The euro right now 108.86 against the US dollar. Under surveillance this morning, opening the door for a hike from the ECB next month. Higher than expected inflation readings out of Spain and out of Germany. Money markets now giving Europe's central bank a 60% chance to hike in September, with just a 20% chance for the Federal Reserve. It's kind of the story of the morning for us so far, Kaylee. Has the data in the last 24 hours shut the door on the Fed, but opened the door for the ECB?
Yeah, seeing the pricing of another Fed hike potential going down at the same time that bets may be increasing for the ECB to make a move. Certainly the data this morning fueling the hawks potentially at the ECB, while the doves got a little bit of fodder in yesterday's data here in the U.S.
They got some love from this. U.S. job openings falling for 6 consecutive months out of the last 7, 6 out of 7 to be precise. The lowest level of openings going back to early 2021, pointing to a cooler labour market. Consumer confidence also falling, Tom, by the most in 2 years. Higher borrowing costs, lingering inflation. So this is the kind of stuff you'd say this was the objective for the Federal Reserve on the job side of things. Going into payrolls on Friday.
Yeah, I mentioned this twice now. Let's do it a third time. Called a hat trick from the peak there in early 2022. For those of you on radio, all you know is the vector's in place, and you say, when does a vector break to a true breakdown of job openings? And I'm almost there, John. I'm not quite there. I need another month or number 2 to say, we're finally getting the job economy falling.
Katie drew an important distinction. It's about the journey, Tom, not the destination. And so far, we're on the right journey, on the right path. We're making progress. It looks so good so far. Let's see what this looks like at the end point. This is what Citi said a million times. The data through summer will give you the impression that things look like a soft landing. And it will always look like a soft landing until it isn't. And I wonder, Tom, how fine the line is between progress that we like and then progress we don't want to see.
It's brilliant you to bring this up, and Veronica Clark was on, I believe, yesterday, and the answer is there's a whole crew pushing against us, and as you say, a journey. I hate that word.
A journey?
A journey, yeah.
We're all on a journey, TK. That's life.
Every time it's a journey at home, someone's trying to take money from me. That's what I know.
I'm on a journey, Dad.
I need to go to Paris. It's a journey.
It's a journey. I need a new smartphone. Apple event, September 12th.
Very good. Nailed it.
It's a journey. I know.
Oh, you have no idea. Are we still under surveillance here? What are we doing?
We are. I've got one more story for you. Just an update for all of you following the hurricane. Idalia downgraded to a Category 3 storm in the last hour, expected to make landfall in the next hour. Idalia threatening a catastrophic storm surge, tornadoes flooding across a large part of Florida and potentially other states as well.
Yeah, the satellite truck we couldn't get worked up this morning with Riley from St. Louis down in Tampa. We'll try to get that hooked up here as we go into the open at 9 o'clock. This is the interview of the day on rates. Ian Lingen has watched across all of global Wall Street. At BMO Capital Markets, he writes incredibly terse, dense notes on the dynamics of fixed income. He joins us this morning. I got 8 ways to go here. One single sentence. Friday, you call most influential jobs report of 2023. Why?
I think that the relevance of non-farm payrolls on Friday simply can't be overstated. The Fed has achieved what they wanted to, at least thus far, in terms of moderating CPI. Now, the question is, have they overshot on the jobs front? We know that jobs are cooling. We are expecting a relatively benign, the consensus, I think, is 170 for headline non-farm payrolls, but we do have that JOLTS print, and the quits rate within that is very troubling. It's now down to 2.3%, which was the average between 2018 and 2019. So we're back to kind of the pre-pandemic norms. So what happens for the macro outlook if we get a disappointing jobs print?
What concerns you most, the number or the speed, the rate of change?
I think that if I were given the choice between the outright level and the rate of change, I would say we're at the right pace. We're just getting to levels that are far more concerning. So I would go with not the rate of change yet, but the outright levels.
Okay, and if the levels and the rate of change suggest that the Fed's work is getting closer to being more fully accomplished, obviously there's still a long way to go. The move in the 2-year yesterday would suggest that that has run perhaps too far. Did we see the peak already? We hit that north of 5%, stayed there for a little bit, and now we're done?
So a lot of that comes down to whether or not the Fed is able to avoid cutting rates throughout the first half of 2024, even potentially avoid cutting rates until the beginning of 2025. Now, I don't expect that will happen, but there's a contingent in the market that thinks that higher policy rates are going to be in place for the foreseeable future. And if that's the case, we're going to see 2-year yields back up above 5% again, which we continue to view as a pretty attractive buying opportunity.
But when we're thinking about how the Fed is going to be thinking about deciding whether or not to cut rates next year, is the bar for that even higher than the bar for them to hike again, given how this Fed has been conditioned by the mistakes it made earlier on?
Mm-hmm. That's actually a great observation. What I would say is the Fed has already signaled that they plan to cut rates by 100 basis points next year, but they're going to allow the QT to run off in the background or to continue shrinking the balance sheet. And so what they're doing is they're reframing the conversation around rate cuts being a response to a slowdown and rate cuts being a recalibration closer to normal policy rates. So I think that they've given themselves a fair amount of flexibility for the year ahead.
And all anybody wants to know is for you to frame the real rate. The 10-year real rate, we got up to 2.0. I've got some numbers above that which show the real stresses. Bracket the real rate right now where it could come back down to that level. We're now at a 1.8384, whatever, and then bracket up. Frame that for us.
If I were to put a range on 10-year real yields, I would put it at 165 to 215, and that's well within what the Fed wants to see.
Okay, but if at 215, I don't mean to interrupt, but this is so important. If we pop to a 215, what does that do to the greater American financial system?
I think that's when we start to see strains in equities, in risk assets, and it becomes a much bigger burden for the overall business community.
Let's put it all together. There's clearly a dividing line between the kind of data this Fed appreciates, wants to see, it's objective, and what you think is undesirable. And what I sense from you is that we're creeping towards the latter and moving away from the former. And if that's the case, isn't the 10-year Treasury in your mind a screaming buy right now?
The 10-year Treasury in my mind is a screaming buy. I think that from here, the path forward for nominal 10-year yields is going to be lower for two reasons.
Oh, slow down. I got to take notes here. It's a screaming buy.
for two reasons. One, the Fed's credibility is being reestablished as an inflation fighter, and that will put downward pressure on break-evens. And one of the reasons that real yields are where they are is because break-evens haven't repriced higher. Think about Jackson Hole. They're holding the 2% inflation target. They're doing everything that they can to convince the market that they're here for the long haul in the battle with inflation. So if we believe, which we do, that there is still a 6 to 9 month lag of monetary policy actions hitting the real economy, the second half of this year is going to be pivotal for the effectiveness of what Powell has been attempting to do.
So is he saying load the boat on the 97-year Austrian?
Not
is that
quite.
What I heard?
Not quite. Not quite.
Is that how I translate that?
10-year Treasury
I got to make some money here.
Ian, I think we've got to put some numbers on it. Difficult to do, I know, but I just want a better understanding of the direction here and what you're looking for. Right now, north of 4%. We got through 4.30 in the last week or so. What are you thinking about? 3? Could I go to a 2-handle? What kind of numbers are you thinking about?
I think that we do get 10-year yields back to 3%. I don't think it happens this year. I think that that will be a first half of 2024 event, but we can easily close in a range of 350 to 375 by the end of this year.
And that's not just monetary policy dependent either. It's fiscal as well. Treasury's still issuing a ton of debt. We have a deficit spending that we need to fund. How does that factor into this equation?
I think that what primarily sets the outright level of Treasury yields are the global macros of inflation and growth. The incremental supply considerations will lead to concessions in and around the events themselves. And frankly, the market knows that there's a bunch of Treasury issuance coming. We have that largely priced in. The Treasury Department has been very clear in their signaling. And still, we have 10-year yields at 4.15, not 5.50.
I look at this, and I just look at what will break. Torsten Slok is out this morning with a spectacular look at Ian Lingen's market has changed, and there's the debt servicing costs up, but we're also back.
I do think that there is a significant mismatch between the primary buyers of treasuries and the incremental players. The people who are fundamentally adding treasuries, whether it's a major central bank or an institutional investor, they're really generally starting to look at these levels as attractive buying opportunities, especially once we have some degree of clarity from the monetary policy side. The incremental investor, people playing for a quick 2 or 3 week trade, I think, are a lot more aggressive on the bearish side. So there does seem to be a fair amount of mismatch.
Ian, it's good to see you. And I apologise, we'll run with that headline all day because I put words in your mouth, but there we go. It's financial media for you. Ian Lingen there of BMO Capital Markets. The Treasury, the 10-year Treasury, TK, a screaming buy. A screaming buy.
A screaming buy, and that means, you know, this is at HSBC. I mean, what the
Steve Major.
Steve Major, he's got West Ham in first place for starters, but Steve Major would suggest that's where we're going, and the only question is the x-axis off what Mr. Lingen said versus what Steve Major says. We're going to see a lower rate regime.
They're taking it out to maybe 3%.
Yeah, the
350 to 375 by year end.
Yeah, well, we don't have the time here to do it. We'll do it later, but I'm sorry. Torsten Slok is back to the irregularities now are like 1959.
I'm reading the same note.
Yeah.
Yeah, I'll get to it in a moment. If you're just tuning in, welcome to the program. Equity markets right now just about negative by 0.1%. Let's get to that note, Tom, from Apollo and Torsten Slok. I'll read it verbatim so I don't get anything wrong. He says, when interest rates increase, the household sector has to pay more for debt. But when interest rates go up, households also receive higher cash flow on fixed income assets. Dividing households' interest payments with households' interest income shows that debt servicing costs as a share of interest income are at the highest level since 1959. In other words, both debt servicing costs and interest payments have increased as the Fed has raised interest rates, but debt servicing costs, Tom, have just increased more.
Huge dynamic here, and we talk about standard deviation basis. I can't explain how unusual where we are right now is on this, and it's just a basic idea within the dynamics of what we owe versus what we earn what's going to break in that. That's what Lingen and Slock do every day.
And as we see those refinancings kick in, Tom, potentially over the next 12 months on the corporate side, 12 to 18, you're going to see that debt interest service costs go up even more, TK, because those guys are still logged in, paying coupons from debt they issued back in the pandemic.
Yeah, and there's huge uncertainty here as well. You mentioned it earlier, how Citigroup really pushes against the consensus.
Big time. They've got a different view. They've got a different view. They've got a different view. Tom, there's two ways of looking at it. You look at the move in the long end and the lift higher that we've seen in yields. You either believe that's a reflection of the extension of the cycle or a recipe to end it. One or the other. Just depends on how you frame it.
Yeah, I agree with that. What I do frame right now is a 1.86 real yield with Ian Lingen talking about 2% is where it gets messy.
We've got a fantastic guest coming up, Seth Carpenter of Morgan Stanley, following the U.S. economic data dump about 47 minutes from now.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I see this as a real, debate between the banking industry and the regulators. And the regulators are rightfully on course to ensure a resilient banking system when you look at the history of the last 50 years. But the banking industry is correct in saying, look at the last 10 years, and loan losses are half at the prior level.
That was Mike Mayo, equity strategist, analyst over at Wells Fargo. Bit of news for you. All tracking Hurricane Idalia weakening slightly to a Category 3 storm as it heads towards landfall. I can confirm now, according to the National Hurricane Center, Tom, that has made landfall in Florida just moments ago.
Made landfall, and as Rob Carolyn said, folks, to scope and scale this for you, he takes it back to 1989 in Hurricane Hugo. He says this is a smaller, more energized hurricane. The outside of the hurricane is not all that dangerous, but the inside is ever so much. And as you mentioned, John, this is about hydraulics. This is about a wall of water coming at some point, maybe worse than the winds.
Well, Tom, you talk about that distinction. It's an important one between strength and size. So the strength of Hugo going back decades, correct? But yeah. The size is incomparable.
Yeah, it is. And again, the shock of Katrina and how big that was as well, and others along the way. My question is, what does the season look like here, set here as we are in August? And that'll be interesting to see. Franklin, I believe, is out past Bermuda, out in the middle of nowhere.
On my screen right now, Tom, tracking pictures live from Tampa, Florida.
Yeah.
The numbers we discussed, as much as 16 feet of seawater could be pushed onshore in some areas of the Gulf Coast. 6 feet could slosh across Tampa Bay.
Yeah, well, all I can say is with the Hurricane Bob, I lived 4 feet, a hockey goal of water coming right at me. And I mean right at me. And John, you're not going to like stop it.
Not at all.
Really serious.
So the latest update for you from the National Hurricane Center, Idalia has made landfall in Florida over the last hour or so. We've reported this, worth reporting again, that weakened from a Category 4 storm to a Category 3, Tom, that hurricane making landfall just moments ago.
We're going to continue forward here right now. Chris Marinak is going to join us off the comments from Michael Mayo there. Mr. Marinak, running research at Janney Montgomery Scott, and joins us from Atlanta this morning. Chris, we're at Jackson Hole, and there was Mary Daly, lovely to greet the head of the San Francisco Central Bank. And X number of hours later, after, my appearance at the $1 Million Cowboy Bar, her head of supervision went out the door. Are we done with the regulatory outcome of what we witnessed months ago?
Oh, sure. I think there's FDIC retirements, too, in that region, Tom. It's just part of the process. I think the noise and the drama is behind us. I think we're back to earnings as usual for the banks. There's still some struggle on net interest margins this quarter, but largely they're all making money. And I think Mike had said yesterday, the credit quality is really good for the industry, and the losses are very limited at the moment.
Did the rich get richer? Did the big banks get ever stronger amid the crisis?
I don't think so. We looked at market share back to 2019, and it really barely changed. So it's up slightly for the largest 6 banks, the too big to fail banks, but that's a minuscule pickup in 2023. Back to 2019 pre-pandemic, it's flat. So we don't think they've changed at all in terms of deposit market share. I think the notoriety has changed, and their recognition as too big to fail certainly is more renowned, but I don't think the market share for deposits, which to me is where the rubber meets the road.
Well, and the deposits have been the concern, and not the big guys, but the smaller ones. And the question maybe should be, are the smaller guys going to get weaker, especially, and I hear what you're saying, you think we're through it in terms of the regulatory response, but a lot of this at this point is just proposals. It still has to go through the comment period. It's going to be potentially years before a lot of these more strict requirements get implemented, be it the long-term debt that the FDIC proposed yesterday, or the capital and liquidity requirements coming from the Federal Reserve. When that does hit, are we going to have to see some of these smaller players consolidate in order to be able to cope with that?
So they're going to consolidate anyways. I think that there's consolidation that's going to happen. We think the relationships and conversations are much stronger now than they were 2-3 months ago. So I think you will see more M&A anyways. I think the reality is the longer the better in terms of implementation of these capital rules for the larger regional banks, because it gives them more chance to organically earn through the cycle, repair their own capital with operating earnings. So it's fine with me if we take 3 years for them to implement. I think that's actually going to be easier. And along the way, the banks will recognize the incremental credit risk that's out there with whatever recession we face. The reality is the smaller banks are actually paying much more for deposits. Customers will do what you pay them to do. Right now, the deposit rates have gone way up, and I think it's stabilizing the deposit flows across the industry, particularly at the smaller companies.
So we should no longer be fearful of deposit flight.
That's correct.
Okay, Chris, just to follow up quickly on the consolidation, you think that will be allowed to happen? Maybe that should have been more my phrasing. If this is a matter of survival for some of the smaller players in order for them to be able to compete with larger ones, does the U.S. actually change its tune on bank consolidation? Because they haven't been all for it.
Sure. I think that it would be great if they would speed the process. The issue is less about allowing. It's really how much grease are there on the skids to make M&A fast. We used to have deals get done in 4.5 to 5.5 months, and now it's taking 12 to 15 months, particularly for the larger regional deals the past few years. If we can make that process faster, you would see more consolidation. That would be very healthy. I don't think that's where the Fed or the FDIC or OCC are, but that's the change that I think you're asking, which is a great point.
Chris, give me a single best buy, but more importantly, tell me why it's your single best buy.
So I like Ameris Bank, ABCB. It's a mid-cap stock in the Southeast. I think the deposit franchise is very much undervalued. A lot of that has to do with the fact that banks hold deposits typically for 4 or 5 years, and there's a big spread between the Fed funds rate being at 5.30 and their cost of funds being at 2 and change. And I think over time that advantage is worth a lot of money. Plus, the securities portfolio they have is small. The amount of loan marks they have are very modest. And the company is a very good earner in terms of their return on assets and their pre-tax, pre-provision. It's just a very good mid-cap stock that I think is undervalued.
So, Palmer Proctor's down there with Nicole Stokes. They got 2,800 employees in Georgia. Are they managing that bank for merger?
I don't think so. I think Ameris is actually managed for growth. They're really set up for organic growth in Atlanta and Orlando and Tampa in the Carolinas. They particularly have a very strong commercial and small business lending engine. They tend to take very bite-sized risks, so you don't see a lot of national lending from the company, and they don't do shared national credits. It's a very simple business model, and they're good at taking deposits. And that's the key to these companies. The lifeblood of any bank is the deposit base. And so I think their organic growth, both this year and the past, has been quite good.
Chris, let's just finish on the chart. Year to date, KBW Bank Index, S&P 500 Banks Index. You can take your pick. Chris, we're still struggling to get off the mat. And it just seems to me that the profitability headwinds that really were highlighted coming through that crisis, if we can call it that, in the spring, haven't gone away. Chris, what turns that around?
Well, John, I think you're right, and we are in a trading range on these stocks for sure. Between 40 to 50 on the KRE would be the way I think about it. I think that the credit issues have to either die down or the banks simply have to recognize enough risk through loan loss provisions. We think the reserve building will continue the next couple quarters, and that's going to create a bigger and bigger treasure chest for banks to write things off in 24 and 25. That, I think, is the ticket. Plus, ongoing, the more that we push out the recession and kind of delay that recognition of a economic contraction, that's going to help the banks as well. And then if we see interest rates fall, if your previous guest is correct and we have the treasuries falling in interest rate, that's going to actually help the value of bank securities and also help tangible book value grow stronger.
Because the move higher in the last month hasn't helped them. Chris, thank you, sir. Chris Marinak there of Jenny Montgomery Scott, the latest on the banking sector and on the treasury market as well. Tom, it's been difficult to get off the mat for those bank stocks over the last few months.
It has been, and I just continue to look for merger as well. Ameris Bank, which is what Mr. Marinak was talking about, your savings journey starts with Ameris. They're having a journey as well.
It's a savings journey.
It's a continued journey.
That works for me
as well. But some of these banks are they're popping some real CDs. You got 13-month CDs, 5.x%, and that's completely different than what we saw a number of months ago.
We got Peter Cheer coming up from Academy.
That's
We're going to talk China.
Yeah,
we should talk China. We should talk about the relationship with China, with Commerce
Secretary
Secretary
with China,
Gina Raimondo, and her journey.
She's having a journey
to Shanghai.
Is anybody responding? We never show video where the Chinese are talking. Are they sending us a message?
Usually there's a joint readout, something akin to we had conversations. Maybe they were characterized as productive. Maybe they will continue. It's usually a long
There's always slight differences in those readouts, Tom, which can be somewhat entertaining. If you are following Hurricane Idalia, many of us are, making landfall just moments ago, the reports from the National Hurricane Center suggesting it weakened slightly before making landfall from Category 4 to Category 3. So the latest headline in the last 10 minutes or so, Hurricane Idalia making landfall in Florida. From New York, good morning.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Markets have been, I would say, very accommodative recently.
I think if there's a surprise, it's rates have one more last push in them.
We are still expecting one last rate hike.
The problem is the Fed could pause here, but we're still not sure they're done.
It's so unclear what path the economy will go and what central banks will do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, Tom Keene on radio, on television. Kaylee Lines, the short straw. She won't be here Friday.
Is that what it's called? Short straw.
They will not be here Friday.
Nice.
I will be here Friday with our Jobs Day discussion, but a ton happening before we get there. In breaking moments ago, John, in Germany, a tick higher in year over year. Harmonized inflation. It's a journey they're having with inflation.
That's their journey.
In Germany, and I'm sorry, there's a lot going on between jolts and the shock of yesterday in America and jolts in the Spanish inflation shock that we saw today.
Down slightly from the previous month in Germany, but it's an upside surprise regardless. And there are some out there who believe perhaps this leaves the door open for the ECB to make a move on September 14th. Others, after the data of yesterday, job opening data in America, believing that that closes the door on the Fed making a move, Tom, on September 20th. So that's where we are. The data yesterday, fuel, ammunition for the doves to take to the table when the FOMC gathers next month. We'll see what we get later today. ADP 14 minutes away. Tomorrow, jobless claims, payrolls Friday. Things can change, but so far so good for the doves this week, Tom, with the data yesterday.
Euro comes off fractionally intraday here, a little bit weaker. Euro, don't want to oversell that. Let's get back on track with the U.S. And John, I'm sorry, something happened yesterday, and no, it wasn't a jump condition, but to me it was boom. Maybe things have changed.
There's a distinction, Tom, between progress and undesirable deterioration. Ian Lingen of BMO in the last 20 minutes on this program suggesting this might be closer to the latter than the former, which is interesting because we spent the last couple of months talking about a resilient U.S. economy. Overwhelmingly, the consensus view is we're making the right kind of progress. Job openings down, back to 21 levels. Quits rate dropping, Tom, indicating maybe we're taking some heat out of this labour market. That's the objective of this Federal Reserve. For Ian Lingen, though, Tom, I would say out of consensus at the moment, going really hard, saying that Treasury market, that 10-year, is a screaming buy. He thinks that yield can drop to 3%, in line with what Michael at JP Morgan, what he's been calling for over the last couple of months. But Tom, where are we now? 4.15 on a 10-year? He's looking for moving more than 100 basis points lower on a 10-year yield.
I'm going to look at the real yield here, 1.86%, down from a 1.9192 yesterday, into the screaming buy that Mr. Lingen has on the nominal 10-year yield. I just wonder, as he framed out the real yield, where that goes, and that could be a changed world for equities.
Well, and he said that where it is right now and up to, what, 215 is where the Fed would like to see it, that they're comfortable with that. And it becomes a question of the Fed's...
for that.
Yes, but at the point, at what John is speaking to, the idea that maybe we're starting to see potentially a real deterioration, what Ian Ling was suggesting, are they going to be comfortable with that? When you still had Loretta Mester as recently as last week at Jackson Hole saying we'd rather over-tighten than under-tighten. Maybe they already have gone too far, but is that what they would have rather done?
But John,
not gone far enough?
Veronica Clark reaffirmed this yesterday on the Mester View. They got a long way to go.
You mentioned Citi. Hold on Horse just published. You'll like this headline, Tom. Jolted by lower job openings. Jolted by lower job openings. But, and there is a but here, a historically low unemployment rate and high ratio of openings to unemployed individuals suggests the labour market remains tight enough to prevent wage growth from sustainably slowing down. Are we making progress? Yes. Is it sufficient? In the mind of Andrew Holdenhorst and Citi, no.
We're going to do a quick data check here, touch on the hurricane, and get to Peter Scheer. John, my data check's simple. I got a VIX at 14.52. It's a bear market. Things are terrible.
Losses year to date on the S&P, there aren't any. They're double-digit gains. Losses month to date, we're just a little bit lower than 2% on a month on the S&P, Tom. We've trimmed those losses
I got
to that.
4,500 SPX. The Dow's nudging 35,000. We're not there. I'm not near 16,000 NASDAQ 100, but hey, it's a bear market.
Equities right now on the S&P, negative 0.1%. If you are just tuning in, unfamiliar with this program, that was a heavy dose of sarcasm underpinning Tom's line there on this is a bear market. In the bond market, yields are higher by a couple of basis points, 4.14 on a 10-year, just about 10 minutes away from that ADP report. Tom, the estimate, for those that care, in our survey, 195 is the estimate for the ADP number, the previous number 324.
Quick on the hurricane here, we have hit land. We've gone from the shock of Category 4 in the early morning hours down to Category 3, and moments ago, a headline of some confusion, Franklin far out in the Atlantic towards Bermuda. John, it's hurricane season.
Tropical storm conditions heading to Bermuda later on today, Tom. And as you say, it's hurricane season and it continues for a number of months.
We'll give you full coverage here. Thank you, Rob Carolyn, for attendance earlier this morning. Thank you to Peter Scheer for attendance right now, head of macro strategy, Academy Securities. Peter, did your journey in the markets, did it change yesterday with the JOLTS report?
Not really. It was more or less in line with what we're looking for. Is basically the Fed is looking for an excuse not to hike. So they're going to be looking across a broad spectrum of data. And I think the one area that's going to disappoint is jobs. I think there are going to be downward revisions. You mentioned a bunch of other parts of the JOLT report yesterday. The hires rate continues to drop down. There's been this dichotomy that the hires rate has been off very strangely low relative to job openings. I think that's going to catch up. So as jobs slow down, I think the Fed's going to have the excuse to do nothing. And then it's going to become a question of, were all the economists, including myself, who are looking for a recession this year, going to turn out to be right or not?
Okay, well, as we talk about whether or not you turn out to be right, if the job market is slowing down, if we're starting to see the growth deterioration happen, but inflation is still too far above where the Fed would like to be, which they say still is 2%, what do they do then?
I think the key word is they say is still 3%. I'm not sure it's really 3%. I think they're going to be looking for excuses to delay. So I think we get 10-year yields back to 4%, and then we're going to need significant either jobs data, consumer sales data, real, inflation data, again, because they're already trying to downplay some of that, saying they're seeing it finally trickle into the housing market. So I don't think they do anything if they can avoid it at all.
Pete, we talked about the housing market the last couple of days. Home prices in America totally distorted by the rates of the last 2 years at record lows and the rates more recently at 2-decade highs. Pete, is that something they can ignore? Can they ignore the distortions of house prices, given their contribution to shelter and what might be elevated inflation for maybe the next year or so?
I think sadly they're going to have to. Partly this is very location based. So when you look at what the home builders are doing, and they've been very successful, they're building homes in areas that people are moving to, right? As people continue to leave California, maybe Illinois move to other states, that's where they've been able to take advantage. So I think we're seeing a very regional economy, particularly on housing. I think the Fed's just going to have to give this time for people to either get forced to move, choose to move, figure out what they're going to do with their mortgage rate. So it's problematic. Again, I think this all goes back, and we're not, going to ham home on this. They were so slow to react. They allowed this bubble to create itself. They should have reacted much sooner, much earlier, done much more. Unfortunately, we're here. So I think this is just going to take time to play out, unfortunately.
Your view sounds like high for longer. Ian Lingen of BMO came on this program moments ago, Pete, and he said 10-year Treasury yield, 10-year Treasury, screaming buy. He thinks yield goes down to 3%. He indicated that, and these are my words, I'm paraphrasing here, but ultimately, Pete, his characterization of the data was this isn't desirable, some of this is undesirable. Maybe things have gone too far. Pete, what's the counterpoint to that?
One, I'm definitely worried that he could be right. So I think we get to this 4% on the 10-year. I think that's good for stocks. Then I think we actually get to 3.8%. As we start moving lower, it becomes negative for stock because people have to start repricing in, is there a potential recession risk? My outlier on the inflation story is really India. I'm watching India to see if they can generate some growth, what happens with China. So if we get inflation, I'm not really worried about domestic inflation. I think we're seeing enough slowing down, both in the goods and the services market. Inflation is not going to be domestically generated. It's going to be something happens with India or China. That could set us off that way. So I'm kind of into an inflection point. Right now, I'm very comfortable. Yields lower, down below 4%, good for stocks. As they go much lower, weak for stocks. Then we'll see how the data plays out.
Peter, overlay on this the geopolitical matrix. Academy is acclaimed for putting a geopolitical tinge on my investment. Is it steady as she goes, or do I need to worry about geopolitics into next year?
I think we need to worry about geopolitics. Certainly what's going on with Russia, right? Putin clearly showed his hand when he was willing to kill the person who went against him. So don't forget what's going on between Russia and Ukraine. But for us, the real story is still China. And I think people are underestimating China's desire to start selling their own goods, their own brands, and possibly denominated in yuan, mostly to emerging markets countries. And when we sit here and examine China today, they are clearly experiencing trouble.
Yeah.
They're going to do some things to fix that. But I think it's going to have to be pushing their brands globally.
Well, Peter, to your point on China, I was really struck by the research that came out in the last 24 hours by our own team here at Bloomberg Economics, talking about China's property sector as being both too big to fail and too big to save. They say the government step in and rescue the sector? When looking at the options, it suggests the load would be too heavy to bear. Is China in a position right now to flex on anything?
That's a great question. So how we're looking at China is I think they are going to cram down on the rich. So I think as this property sector resolves itself, they're going to try and protect what's left of the middle class, and it's going to hurt the rich. But I think those are all relatively weirdly short-term problems. The real problem that they face right now is, one, no one really wants to produce in China, right? People are moving their production out of China. That is not going back. It's political. It's too long term. So they're not going to be this factory of the world any longer. And it's clear that, one, Chinese customers don't consume the way American customers consume. So their ability to develop a real domestic economy is weak. They're going to have to support that with the housing market or the real estate market there so people can spend. But they are going to have to look to selling their brands offshore. That's the only way they're going to be able to produce enough goods to keep people employed. And I also worry, and I think our geopolitical team always cautions us, right? When things are good in China, they are less likely to flex their political or military muscle. As their economy weakens, they can do something like that, just like we saw Putin do.
Well, Pete, bad folks do bad things. What kind of bad things are you thinking about?
I think Taiwan's off the table. It's not going to be that. But look for them maybe to flex their muscle in some other regions of the world where people care less. Look for them to continue to expand through their Belt and Road Initiative, more access to ports, more access to these countries who are failing to pay on that. And I think you're going to start hearing more and more trade occurring in yuan. And that's something people kind of, I feel, under denial because we're getting a lot of anecdotal evidence when we talk to companies. They're being pressured to do some contracts in yuan. It's very small, mostly isolated emerging markets, but this was not something anyone was talking about 2 years ago. So I think this trend is there, and I think U.S. companies are going to have to take a real stock of, hey, do we have exposure to selling our products in emerging markets? Because China might become a real competitor. How do we deal with that?
Well, Pete, I want to talk about that just one step further. Domestically in China, how are U.S. brands going to compete on the mainland in the domestic market, given the kind of things that we're discussing right now?
I think it's very difficult. I think everyone still has this, it's impossible not to look at 1 billion customers and say, wow, if I could just reach a fraction of this, I'll do well. I think the regulatory hurdles are going to remain extremely high. I think China's not really going to be friendly. So you can go there, but I think you want to put in limited intellectual property, limited resources, because that's not the wave of the future. If anything, I think you're supposed to be figuring out, what do we do with India? India is a much more compelling case to me right now than trying to figure out how to sell into China. But clearly this friction's ongoing, and the reluctance for them to do business with us is increasing.
So, Pete, I've got to raise this question, and forgive me for bringing single names into it. You can answer it directly if you want. You can dance around it, but it's got to be said. Where does it leave Apple? Where does it leave Tesla?
I think we're already seeing some of those companies move their supply chains, develop around this, right? So they're looking at that, and I think that's been stage one of this. I think stage two is going to be, how do we protect our brands in some other countries? So I think companies are now maybe a little bit behind as a whole, but dealing with the China issue. And I think what they've got to get ahead of is, what are we going to do with the rest of the emerging markets as China becomes potentially a competitor of low cost? They're going to flood the market with their low cost, maybe lower quality goods. And that's, I think, what we have to be thinking about. So I think companies have done a decent job adjusting to China. I think they were slow as a whole, but that's going to be really the next phase, is adjusting to Chinese competition.
Pete, before we get ahead of that, let's get ahead of this. ADP, the number just around the corner. I've got to go to Mike McKee in a moment. Pete, what are you and the team looking for from ADP today? Claims tomorrow, payrolls Friday.
I'm looking for weak numbers, and whether it's in the headline numbers or, more importantly, even the revisions, because we've seen pretty significant revisions lately that people have somewhat ignored. I think it's just going to kind of really solidify this view that we are the best for employment's behind us.
Peter, thank you, sir. Peter Cheer of Academy Securities. The best on employment is potentially behind us. The view of Pete just moments ago. Job openings yesterday, down aggressively. Quits rate lower, just indicating further progress, desirable progress in the eyes potentially of this Federal Reserve. Later on this morning, 30 seconds away, ADP report 195,000 is the estimate. The previous figure, 324. Tomorrow, jobless claims. The estimate at the moment, 235,000. The previous number, 230. And then it's on to payrolls, the big one on Friday. And over the last couple of years, we've seen some monster numbers. We might be seeing some of the kind of numbers we were used to before the pandemic. The estimate at the moment, 170,000. The previous figure, 187. ADP just around the corner. Equities going into it virtually unchanged on the S&P 500. With the data, here's Mike McKee.
Good morning, John. 177,000 jobs were added to company payrolls, according to automatic data processing during the month of August. Annual pay up 5.9%. Now, you pointed out the 195,000 forecast from economists for ADP. This is a very difficult one to forecast, so it usually doesn't come out correct. The one thing we can tell you is that ADP for the past 6 months has averaged 116,000 more jobs per month than the payrolls report for private sector jobs. Remember, this is private sector, not total employment. So it tends to overstate this year where we are. That is maybe not great news for Friday, because right now economists are only expecting 148,000 private sector jobs. So let's see what ends up happening. By industry sector, we do have 23,000 jobs in the goods producing sector, including 12,000 in manufacturing, 6,000 in construction. And the story has been in manufacturing that they're starting to get rid of people. That doesn't seem to be the case. 154,000 service providing jobs. Of those, 52,000 education and health services. That could mean some seasonal adjustment issues, back to school time now, and leisure and hospitality, 30,000. In terms of the size, 18,000 small businesses, 79,000 for medium, and large establishments, 83,000. So it's the big ones that were adding people. Median change in average pay, 5.9% for job stayers, 9.5% still for those who are changing jobs. So ADP comes in lower than anticipated, higher than the forecast for private sector jobs for Friday. So we have 2 days to discuss.
This is what the Fed calls progress. Yesterday, and this morning. Your equity market off the back of it, slightly higher, just about turning positive on the S&P 500. Just to pick out the bond market, the front end of the curve, the 2-year yield was a little bit higher, a little bit lower now, 489.63. So aggressive rally in the front end of the Treasury market yesterday off the back of job openings. We continue that just a little bit, 489 on a 2-year after 6 consecutive sessions of closing above 5%. We're back down to the 480s, Tom, on a 2-year. And off the back of that, as you might expect, anticipate, euro stronger, dollar a touch weaker, very close to 109, Tom. In fact, higher the session was just seconds ago, 109.01. Right now, 108.94.
Just moving here in the last 30 seconds here. What's interesting here, John, is, you get to claims tomorrow, and maybe that's got some greater veracity than ADP in terms of affecting the market. What I would note when I am here on Friday, what we will note is an important jobs report. And what's more important than the fact I will be here on Friday is what you said earlier, the inflation report looms in September. And I'm sorry, perhaps that's a bigger deal than all this labor dynamics.
Mike McKee, can we go to that? Have we truly slammed the door shut on a hike in September, given we still have payrolls on Friday, claims tomorrow, and as Tom indicated, on September 13th, CPI?
I don't want to say that. I saw this morning that some people were talking about something like that. You've still got the PCE inflation numbers tomorrow, and you've got CPI coming up, I think the 13th of September or 14th of September, and those could change the Fed's mind. You saw what happened in Germany today. CPI comes in higher than expected, even though their economy has been contracting or flat. So there's always the possibility of a surprise out there.
Mike, one more here. You taught me that the JOLT survey matters. Literally, folks, when McKee talks, I take notes. And you told me the JOLT survey mattered. Was yesterday game-changing for Mike McKee?
No, I would say it continues the trend. It's what was expected, a little bit more in terms of job openings going away, but we're still well above the level of of those who are unemployed when you talk about the number of people who are. So we still have some ways to go. The Fed would like to see a 1-to-1 ratio. I think we have 5.8 million, 5.3 to 5.8 million unemployed, and you've still got 8.8 million job openings. So it's not a slam dunk yet.
Mike McKee, thank you so much. Of course, leading our jobs coverage here on claims tomorrow and onto the jobs report on Friday. Green on the screen. We had red on the screen earlier, now green on the screen. It's fractional, but nevertheless a subtle shift in the market. Senior Vice President, subtle shifts for us in foreign exchange and rates is Edward Harrison. Ed Harrison joins now from Bloomberg. How did your world change yesterday with the JOLT survey? I was like, the cliche, boom. No, I wasn't there, but nevertheless, boy, did things change.
I look at yesterday as more of a short covering rally than a fundamental move, although there are those in the Bloomberg sphere, especially in Asia, who are looking at a 2-year yield as having peaked, which gets you the front, the hike cycle and any cutting as well. And they looked at this as like, okay, now we're at the turning point for real. But we've called turning points many different times. I didn't look at yesterday as fundamental.
Well, and it's one thing to suggest a turning point as like a real pivot. There's another suggestion that may be more of a soft curve. Just looking at the ADP release here, the chief economist, Neela Richardson, who is often with us here on Bloomberg, says after 2 years of exceptional gains tied to the recovery, we are moving toward more sustainable growth in pay and employment as the economic effects of the pandemic recede. Movement, yes. Arrival, though, as we've been speaking about all morning, is very different. Is anything going to be sharp as this cycle changes?
That's a good question. And I think for me, on a week-to-week basis, jobless claims are good in that. I thought it was interesting, some of the numbers that Mike McKee was talking about. He talked about 116,000 for the services. He also spoke about, small businesses being very light. I'm what you would call a birth-death model truther, if you will. And at cycle turns, I think that the birth-death model, which says, small businesses, this is how many firms are adding and this is how many are subtracting, overstates the number. So I look at that paucity there in this number as reflective of an overstatement, that we're going to see revisions. And so the true picture in the labor market is slightly weaker than we would have thought.
At the moment, it looks like a soft landing. The less constructive view would be that we're confusing the journey with the destination. that it always looks like a soft landing until it doesn't.
Ed, hold my hand, please.
I got this line a moment ago. We're winding him up this
my
morning.
Lord,
I got this note a moment ago from a
destination.
terminal subscriber that read as follows. Targeting a lagging indicator, CPI, with a leading economic input, interest rates, is a loser's game. How difficult is it to win that game?
It is very difficult because it turns on a dime. When you look at the previous recessions that we've had, you've had very good growth right up into the quarter that we printed negative on, and when the recession began. So it's the numbers that we're seeing now are not necessarily indicative of what we're going to see in 3 months' time. Moreover, I think if you look at what Anna Wong, who's Bloomberg's U.S. chief economist, is saying, she's saying that actually we have stellar numbers. If you look at GDP now, it's roughly 6% for this quarter. That's going to be payback coming the fall and then eventually the winter as well. So the game's not over yet in terms of the soft landing. It could be a soft-ish landing, and it could also be a hard landing for that matter.
Yeah, I'm looking at the Bloomberg Financial Conditions Index, and if I'm Jerome Powell, I'm nowhere near where I want to be. Do we have Hollenhorst on tomorrow?
We do.
8:30. Are you here tomorrow?
8:30 I
Well,
am.
Andrew, that's great. We've got
Not
John
Friday,
Farrow and Andrew Hollenhorst with us tomorrow. And the answer is there's a crew looking for a higher yield environment, and John's waxing philosophical about the journey and the destination. Baloney. The Bloomberg Financial Conditions Index is in no way restrictive. Why?
Yeah, and that's because real yields really haven't gotten there yet. And I think that's the next mountain to climb for the Fed. I thought it was interesting, Loretta Mester, she was talking to Mike McKee at Jackson Hole, and she was talking about that as doing the heavy lifting. To the degree that we don't get inflation going down over the near term, i.e. we all the base effects have been baked in, and we're going to actually see inflation go higher, it's not going to be able to do that heavy lifting. So it's not a done deal that we're the rate cut for September or November for that matter. I think November is the real key. We could get another rate hike rather in 2023, specifically because we need to get at least, according to the dot plot, 0.3% per month in the back half of this year on inflation, and we may not get there.
You consider September a live meeting still?
I do, and I would consider November more live than anything else. Okay. If you think back to how we were talking skip meetings kind of thing. So we got a hike. Maybe we'll skip in November, see how things play out, and that gives you another 6 weeks until the November meeting. And therefore, they can get the hike that they talked about in their dot plot in June, which I expect to still be in the dot plot in September.
I had no idea you had a new title, Ed Harrison, Senior Vice President of what, Tom? Subtle Shifts.
Subtle shifts.
Yeah,
it's great.
And live meetings.
Yeah.
I'd appreciate it, buddy. It's good to see you. In the next hour on Bloomberg TV, here's your lineup. Kelsey Barrow of JP Morgan Asset Management, Krishna Mamani of Lafayette College, Keith Lerner of Truist. All of that coming up with your equity markets slightly positive on the S&P 500, with the ADP report, Tom, delivering just a little bit of a downside surprise.
I got to squeeze this in. I mean, I got major troubles on Saturday, John. I mean, I don't know what to do. You're going to have to help me. I got UVA football, and then I got Monza Qualis.
Quali, that's easy.
It's easy. You got to go.
That's
you got to go Monza Qualis.
Go Who's. Even you're not going to watch the football.
Same
weekend.
time. Do I big little them?
Give me a break. Katie's making this up. Katie doesn't watch UVA football. Watches UVA basketball. There's a difference.
Lead the fifth.
There's a difference. From New York City, this is Bloomberg.
names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bramo is off. Kaylee Lines picked the short straw and is in today. It's a journey towards her destination, and good to have you here. And so it begins. Yesterday, Jolts, okay, big deal. But right now, at this moment, the onslaught begins. We will see this Wednesday, Thursday, and into the jobs report in early September month data here on Friday to give us wisdom in perspective as the numbers launch. Michael McKee is with us with our end of August data. Michael, what do you see in the first look here on a Wednesday?
Well, we've got some GDP numbers, a revision to second quarter growth of down to 2.1% from 2.4%. Personal consumption, however, revised up from 1.6 to 1.7. So that will go into some people's estimates of what it's going to be like for spending in the third quarter. The GDP price index up 2% on the month, on the year-over-year basis, quarter over quarter 3.7%, but those kind of get overlooked because we'll get the numbers for July tomorrow. But we do have some numbers also that bear on third quarter growth. The first round of stuff that comes in, advanced goods trade balance widens significantly to 91.2 billion from revised 88.8. Wholesale inventories are down 1/10. They were down 7/10 last month, so that'll be a contributor to GDP. Retail inventories up by 3/10. That's lower than the 7/10 gain the month before, and lower than what was anticipated. So you put it all together, and basically you got a little stronger growth going into the third quarter, at least among some of the components that will make up those things. But it is only the first month of the third quarter that we're looking at.
Dive into that, Mike. Look at the revisions as well, because we do have a market move. We got a lift in equities, which is tangential to a weaker dollar, demonstrable in euro 109.11, 1.0911. Euro stronger here by 0.3%. Yen has made the journey to its new destination, Kaylee. We've gone from 147 level into 145. Seth Carpenter is looking at me like, what is going on? 146.01 on a stronger Japanese yen. Even sterling vaults out near a 127 level. I look at the 10-year real yield. That's what we'll talk to Dr. Carpenter about, and the answer is 1.83. Kaylee's a little bit different than where we were 3 days ago.
Yeah, well, a lot has changed over the course of the last 24 hours as we see these movements in the bond market, Tom. The continuation of yields moving lower off of the back of data that would suggest that maybe it's playing into the doves at the Federal Reserve's favor.
Mike, GDP price index 2.2% is 2.0. That's a demonstrable lessening there. What is the GDP price index?
Well, it too is the deflator. It's the price index they use to deflate nominal GDP to constant dollar GDP. And so it is coming down, but again, that's a quarterly average as opposed to a month by month, and the Fed wants to look at the month by month to see what the sequential progress is. Might mention here, this is the first GDP revision that gives us profits of for American companies, and this is not all just public companies. This includes private companies, and profits decreased 10.6 billion in the second quarter, which sounds terrible, but in the first quarter it was down. They were down 121.5 billion. So there was a lot of talk going into this year about profit recessions. Looks like we had something like that in the first quarter, and things are getting better now.
Well, and I hear a lot of talk in Washington, where I usually am, that the reason we're seeing inflation, at least this is the argument on the Democratic side, is because of price gouging and profiteering on the part of corporations. Just quickly, Mike, especially given that last week Chairman Powell was talking about above trend growth and the risk that it poses to the fight against inflation. How much does a revision lower in GDP help to maybe ease concerns around that?
Well, I suppose it eases some concerns, but this is always a question of what have you done for me lately? The Fed is going to be looking at what the third quarter numbers are, and the Atlanta Fed, they come out with a new estimate update tomorrow. The Atlanta Fed is at 5.9%. So nobody thinks it's going to remain at 5.9%. The math is you got to bring it down a lot to get to trend growth or below.
Mike McKee, thank you so much. Greatly appreciated. Again, we got equities with a little bit of a lift. Yields mix, red and green on the yield screen as well. Again, the real yield 1.83%. Brent crude, I've been watching here, 85.88, pulls back a little bit from the 86 level. He wasn't at Jackson Hole. He should have been. He would have done the 31-mile paintbrush divide hike. It goes way up in the tundra there at 12,000 feet. Dr. Carpenter darkens the door. With many years of experience at the Federal Reserve System, Seth Carpenter is with Morgan Stanley. You have to corral Zentner when she's not in some trout stream trying to catch trout. What is the Zentner mood now, the Morgan Stanley recession meter? Have we just discarded recession?
So I wouldn't say that we've discarded it wholesale. There's always a risk. As I like to say, bad things happen to good economies all the time, Tom. But, you know, since the beginning of this hiking cycle, we've tried to say a soft landing is the most likely outcome. The economy is not going to go into recession as a base case forecast. And so far, that view has come true. I mean, it was not, I have to say, the most popular view with our clients 3 months ago, 6 months ago, 9 months ago. On the other hand, things haven't slowed down quite as much as we thought it would either. Mike was talking about the GDP data. The downward revision sort of pulls things sort of along the slowing line, but it's still a pretty punchy number. 2.1% is above, I think, most people's estimate of potential growth. So we still have a ways to go. We still think there's more drag from monetary policy in the pipeline. But inflation's coming down. Job growth is slowing. We'll get another print on Friday. Our number is, I think, around 155 for private payrolls. So that'll be another tick lower in terms of job demand. We saw the JOLTS data that had a market reaction as well. So things are cooling off a bit, but they're not cold.
The hallmark of Morgan Stanley economics is invented by Stephen Roach and Richard Berners. Everybody fights like cats and dogs. What is the point of conversation around the desk at Morgan Stanley? What's the thing everybody's arguing about?
Gosh, right now I have to say every corner of the world has its own quirky story. I mean, I think for us in the U.S., there's definitely the slowdown, the soft landing, but boy, the data are surprising to the upside. In very stark contrast, on the other side of the world, I'm always in conversation with my team in Asia. China, we had come into this year pretty bullish on China. The first quarter was super strong, and now things have slowed down a great deal. And so the question is, when do we get enough of a policy response from Beijing to pull things back in? So that's where those are two of the main topics where we're really debating.
Yeah, and we've talked about China a lot in recent weeks because it just seems like piecemeal, one thing after another, they're doing things to try to stimulate that economy. Just to return to your soft landing thesis and the avoidance of a recession, are we really talking about a recession entirely avoided, or one that potentially is just pushed off, just delayed further out into the future as we think about these lagged effects kicking in a way they have not yet fully?
I mean, I think that still remains a key question for us. We still think it is a recession avoided. That's been our view for a long time. The trough, though, in terms of economic growth, does seem like it's got pushed off a little bit. We think things will come down further from here. And there are things besides monetary policy that are a downside risk for the rest of this year. I mean, student loan moratorium, that has gone away. If you look at the Treasury's daily Treasury statement, you can start to see some of those inflows going. So that could weigh things down on Ellen's team. Sarah Wolf is our consumer specialist, and she's been all over student loan debt repayments as a really key downside risk for the fourth quarter. So are there still risks of a recession? Absolutely, there always are, but we don't think that's the main story, that the labor market slowing but still resilient.
Yeah, in October, that's definitely going to be something of concern. 2 weeks before that, though, actually just 2 weeks from tomorrow is when we're on watch for a United Auto Workers strike. How are you thinking about the labor movement in particular? The power of these unions to ask for things as audacious, to use their own words, as a 46% pay hike. What does that signal to you about still the supply issue and the ability of workers to demand more?
So I think it's definitely something that's going to matter a lot. It's going to have, we already have one strike in the books, right? The Screen Actors Guild and all of that, and that's going to have an influence on Friday's jobs report. And so we're going to have to try to read what the underlying trend is in data. So I think the first part of it is going to be not to be, hopefully avoid being confused by swings in the data because of if there is a strike with the United Auto Workers, what that means for the numbers. But yeah, I mean, you've got a question of how long are they on strike? How much does that disrupt production if they are? We know that the auto industry was one of the last ones to be able to catch up to supply chain disruptions. Now we're starting to see auto prices fall, so it's a real mixed bag. I think we're going to be trying to watch very, very closely. We're going to pull in our equities analysts who cover the auto industry to see sort of where production is going. But for now, you know, I don't think it's easy for us to forecast whether or not the strike will happen.
At your Princeton, a guy named Bernanke wrote a really important paper, Bernanke Del Negro, on R-Star. We missed you at Jackson Hole. Give us the Carpenter R-Star debate. Should our audience pay attention to it, or is it economic babble distraction?
It's a little bit of both. I mean, it's hard to avoid the relevance of the concept of R-Star. So how high is the level of interest rates that's neither stimulating the economy nor putting a drag on it? That's got to be fundamental to everything about the economy. But in real time, at any specific point in time, knowing where that is with any precision is borderline impossible. The statistical models that lots of my academic-minded colleagues use are really, really, really sophisticated ways of showing off how much math you know. But at the end of the day, all they can do is say, we know where the current level of interest rates is. Let's just look. Is the economy accelerating or decelerating? And then we make an inference about whether we're above or below R-Star. So I don't think there's a whole lot there that you can judge for sure right now. Over time, if the Fed keeps the policy rate where it is now and the economy not only doesn't slow but starts to accelerate, a quarter from now, 2 quarters from now, you gotta have a view. But the same thing could be said. There could be extra residual push coming on from fiscal policy. That doesn't tell you anything about the permanent level of R-Star. That just says right now there's more demand.
Dr. Carpenter, stay with us. Mike McKee, I want to go to you. You've had time to dive into the data here. Give us one insight here in about 40 seconds.
I'll give you an insight that doesn't have to do with the numbers that came out today, but what you were just talking about with Seth. The Labor Department estimates how many people will be subtracted from the payrolls number because they were on strike during the month. And we've averaged somewhere around 1,000 a month all this year. For the month of August, 17,800. So there's your screenwriter's strike, and you're going to have...
So how does that fold into the 2 jobs reports on Friday?
Well, it's going to take away from total job creation. We'll see a 17,800 lower jobs, and these are all likely from the
So our journey to our destination on Friday is completely beholden
I've
by
created a monster.
She's created a monster.
The Los Angeles strikes.
Dr. Frank and Kaylee. It'll be interesting to see, though. And, of course, obviously, as Seth said, if we get a UAW strike, that will be
That's a granularity, totally folks, we're going to inflict on you here in the next couple days. Markets are on the move. SPX was red on the screen now. Standard & Poor's 500 up 2 points at a flat percent. We say good morning to all of you. With us, Dr. Seth Carpenter of Morgan Stanley, their global economist, as we get some final thoughts from him this morning. Seth, on the dollar as well, everybody was calling for weak dollar. The Morgan Stanley view on dollar resiliency.
Yeah, so I mean, I think we have lots of cross currents here. I think one reason why some of the dollar bulls had their views is the real side economy data have been coming in stronger. The part that my colleagues, our FX strategists, will always point out, though, is that anytime you're in a risk-off situation because the economy is looking better, you can sometimes get a weaker dollar, and so you've got these cross currents that are really important. I do suspect that people feel more or less they know where the peak is for the Fed. We think the Fed's already done. The market's putting some probability on one more hike. But, you know, it's not like there's a long way to run in most people's mind at this point. Similarly, for many of the other central banks, I think we're either at or getting very close to the peaks. And so that part is there. And so I think it's going to come down to a lot of sentiment, some positioning, and then relative economic performance.
Seth Carpenter, thank you so much. I want to do a tag team thing. You got to bring Ellen Zentner along one day so we can do it like a Morgan Stanley. You two can argue with each other watching real time. Kaylee Lyons and Tom Keene with you to get you through to the hour. We've got some good things coming up. And included with that, Kaylee, is a changed market. I've got the 10-year real yield, my number one thing. It comes down even lower, distant from 2%, 1.82%.
Yeah, and in nominal yields, the 2-year yield right now, 4.85, down another 4 basis points today after a monster move lower yesterday on the JOLTS data. No longer are we in that north of 5% camp.
The VIX comes in for actually 14.40. Could we get to a 13 handle on VIX today? That would be shocking. On radio and television, stay with us. This is Bloomberg Surveillance.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this.
I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
At the end of the day, we've had this just bearish onslaught of Russia news and of China news, and what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership.
Chris Verone, strategist, starting us off strong on a Monday. Houston, we have a problem. We're going to go to Houston in a moment and really discuss $90 or higher oil. We can do that with some sophisticates at KPMG. We'll get to that in a moment. I have a lift in equities off of the red that was on the screen earlier. We're fractional. It's boring, but it's not. Friday up, Monday up, yesterday boom off the JOLTS data, and it continues today in a more quiescent way. We'll have to see how that goes. Futures up 3, Dow futures up 32, the VIX 14.4 is 0. Brent crude 85.75. With our movers this morning, Kaylee Lyons.
Yeah, not everything is moving higher today, Tom. One stock actually moving lower, potentially heading for its worst single day in more than a year. is HPQ, the ticker, HP, remember there's HPQ, there's also HPE. This stock down 8.3%, cutting its profit outlook, acknowledging that a rebound in PC demand is not coming as quickly as it hoped. And that stock down as a result. Brown-Forman also down 3.5%. This is the maker of Jack Daniels and other alcoholic libations, Tom.
Really?
Yeah. Missed estimates, margins more narrow than expected. Guess Tom isn't drinking any Jack Daniels, just G&Ts out of Jackson Hole. That stock is down. And finally, you have to check on VinFast as well. This is the one that has been capturing a lot of attention. It just went public via a SPAC just a few weeks ago,
mid-August. You do this just to aggravate me.
Yeah, kind of. That's what I'm here to do, Tom.
No, Bramo does it. You aggravate me. Continue.
It had been up more than 700% since it went public via a SPAC. This is a Vietnamese EV company trading kind of like a meme stock. Then it came back down to earth to the tune of 44% yesterday, right back up today by 11%.
Now I'm looking here. You go to the Bloomberg terminal, and I guess you see the financials. I thought they were going to come up in Vietnamese dong, but they don't. They come up in U.S. dollars. It's a sort of sketchy, financial. It's a SPAC, right?
Yeah.
Explain SPACs on the next break, and I'll get a chance. I want to go back to what you saw there with your first stock, HP, and into Apple and the mystery of their relaunch that we're going to see.
Yeah, September 12th.
You wonder how the iPad and how personal computers like HP fits into the future.
Yeah, it's a really good question relative to Mac and what the upgrade cycle is going to look on something like an iPhone versus those other devices.
Let me go to oil right now. We've really ignored this to our great regret. That had to do with Jackson Hole and, monetary theory and the dance and all. Angie Gilday joins us right now, U.S. energy leader at KPMG, and they have a franchise in Houston of looking at the market. The view from 60,000 feet, Angie, what's the thing we most misunderstand about oil in America?
Well, I think the thing that people most misunderstand is just how many factors go into predicting and the ultimate oil prices. There are so many factors, whether it's the economy, the outlook in the U.S., the outlook in China, geopolitical crisis, hurricanes in the Gulf of Mexico. I mean, there's so many things that go into the price of oil that, especially in today's market where we have just such a tight gap between supply and demand, any little injection of uncertainty creates volatility. And that's certainly the space we're in now.
In the 42-page PowerPoint from KPMG, there's got to be bullet points. What's the key bullet point on demand right now? With demand, microeconomics, and price theory, what's the key mystery?
Well, key thing is demand is still growing. Largest countries, U.S., China, India, but questionable continued growth trajectory, particularly coming out of China.
Well, yeah, and we're seeing evidence of the struggles in the China growth story each and every day as we see policymakers there trying to take steps to shore things up. That's on the demand side, though. What about on the supply side?
Well, on the supply side, the OPEC and Saudis clearly believe that they're in the driver's seat. And as you all know, they extended their quotas, extended it from expiring end of 23 into 24. And so you had that. And then the Saudis came on top of that and extended another 1 million barrels per day production cut on top of that. So that's in an effort to boost up the price of oil. Their budgets to balance their national budgets, 80s are kind of a sweet spot for them. So that's happening from a supply front.
Well, on the subject of supply, as it relates not to the supply coming from OPEC, but here in the U.S., especially in the Gulf area, Angie, watching storms like Idalia that just made landfall in Florida within the last hour or so. How should we be thinking about that potential impact?
Yeah, well, first of all, our hearts and prayers go out to the folks in Florida. Being a Houston resident, I certainly appreciate the stress they're under right now. Fortunately for this particular storm, it was further east of where our major production and refinery facilities are within the Gulf Coast. But 15% of the U.S. production comes out of the Gulf of Mexico. And from a refining capacity, the Gulf Coast refines just over 8 million barrels per day. And it's about 47% of our total U.S. refining capacity. So it's a very, very important region for us. for the U.S.
Angie, when you're in meetings at KPMG, and folks, the heritage of KPMG is there's really a lot of discussion here. If they're writing up a story betting on the future of automobiles at KPMG, how does an oil expert like you react to the EV mysteries that are out there?
Yeah, well, first of all, the EV will play out different places in different regions. So we see it as a mosaic. So what happens here in the US is going to be very different than what happens in places like Southeast Asia or India, where we just have a different economic outlook. But here for the US, I mean, EVs are definitely growing. We're seeing more of a trend towards electrification and power, which for me as an energy person, that's also important because we've got to make our grid more resilient and modernized in order to be able to charge all the EVs that will be out there.
Are EVs efficient? I mean, you're perfectly positioned for this. I mean, there's a whole idea that EVs are efficient, and there's a debate with ongoing research of where we're going to end up with battery removal and all that. What is your take on the thermodynamics, underlying science of EVs?
Well, I'm certainly not a scientist, but I think from an EV perspective, look, I've owned one. I'm an energy person, and I've owned an EV since 2015. There are some incredible benefits to an EV. However, there is a challenge from a metals perspective on the batteries. It takes a significant amount to produce the EVs. Then you think about the recycling of the EVs themselves. So we do have a challenge on the back end and front end in terms of mining the appropriate metals. And they're not in places in the world that are really stable from a geopolitical standpoint. So we've got a challenge there if we're going to continue to scale up. And then we have an infrastructure challenge. We've got to be able to charge them. We've got to be able to service the charging stations that are out there. So this is going to be a long journey that is going to take a number of years for us to transform our energy system.
This has been wonderful. Angie, thank you so much. Angie Gilday with us in Houston at KPMG with some real clarity there, knowledge-based, out of the KPMG, their advisory on EV. I'm sorry, this is a huge debate. John's been very good about this, about what actually is the research of destroying batteries, moving on from batteries. It's a huge, huge deal.
Absolutely. And this actually is at the heart of the United Auto Workers question as well. This EV transition and where a lot of these employees fall into that, what their jobs look like going forward.
And basically right now, EV is less paid, and the UAW wants EV to be equivalent pay with gasoline engines.
This is one of the focal points of these negotiations ahead of that contract expiring.
What'd you learn today on your journey to your destination of leaving me Thursday because I'll be alone here Friday?
I've learned if I say something once, you're just going to keep running with it.
You got that. It's a theme here. It's how we entertain our way through the morning. Look at the 10-year yield, 4.09%.
Yeah, 2-year at 4.84 as we see more economic data that would seemingly be in favor of the doves at the Federal Reserve following the JOLTS downward surprise yesterday, consumer confidence downward surprise. Then you get a downward revision in the second reading of second quarter GDP. All of that, though, of course, beating the drum to the data we have yet to get this week. You got jobless claims tomorrow in the big one. Quarter GDP. All of that, though, of course, beating the drum to the data we have yet to get this week. You got jobless claims tomorrow in the big one on Friday.
We go further at surveillance. Euro reaches through 109, back up stronger. Euro 109.25. Euro yen, take out the dollar. Euro yen a 159.36. A 160 euro yen would be something. It is an eventful Wednesday. On to our coverage Friday. We'll go beneath the headline data at 8:30 on Friday. The American Jobs Report. Stay with us. This is Bloomberg Surveillance.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
From the world of politics politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Limes.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Live from New York City this morning. Good morning, good morning. After the biggest one-day pop on the S&P 500 since June, let's see if we can make this a 4-day rally. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, jobs data in the US providing a gift for the doves as inflation in Europe opens the door for another hike and China's stimulus plans fall short of expectations. We begin with the big issue, fuel for the doves.
When you look at the data,
The JOLTS data,
the drop in consumer confidence,
there are a lot of indications that conditions in the labor market are cooling off a bit. We're starting to hear a little bit more in terms of softer employment.
the question is this the data point that Fed needs to get near the end of the tightening cycle?
I think we are seeing enough signs of slowing growth.
We have more confidence that the Fed is done with their tightening cycle.
A little more comfort that maybe they don't have to necessarily hike again.
Feels like the Fed should be done. The Fed will pause.
Pause in September.
Now it's getting into that, how long do they pause before we start cutting?
The jury's still out as to the ultimate direction of the economy and labor, for that matter.
We have to look at everything.
Let's wait and see how the incremental data points come out.
Joining us now is JP Morgan's Kelsey Barrow, Krishna Mamani of Lafayette College. Kelsey, first to you, and great to see you both. Are we making sufficient progress in this labour market?
We do think we're making sufficient progress in slowing demand and improving that imbalance between labor market demand and supply. So I think there was a key data point, of course, it's been covered now for over a day, which is the JOLTS report. The things that caught my eye were particularly the quits rate, which is now back to pre-COVID levels. We've found that that has a fairly high correlation with wage growth. So wage growth is coming off the boil. Also, the hiring rate is down to the lowest level since January of 2018. So not just back to 2019 levels, but actually weaker than that. And this is really what we've been anticipating within our call, expecting that the labor market was weakening beneath the surface, that we would see it more explicitly in the headline data as the year progressed, and this would allow the Fed to be able to pause at this level of the Fed funds rate.
Job openings down, quits rate lower, ADP report downside surprise for whatever that's worth. Krishna, how thin is the line between progress and undesirable deterioration?
Well, so first, let's kind of talk about progress for a second. So we have been making progress on the inflation and wage and employment front for quite some time. Things have been slowing. But the real question, right for now anyway, is are we slowing down fast enough? And I don't think, we are slowing, but I don't think we are slowing down fast enough for us to feel comfortable that the pause is not going to be a very extended pause. Having said that, I think it is also worth remembering that in the first half of this year, a whole bunch of things came together to provide the impetus to the growth outlook for it to be extraordinarily better than what we were expecting beginning of the year. I think there is a good chance that things reverse, and but that reversal probably doesn't come in the third quarter. We will probably see signs of that more likely in the fourth quarter, or even more likelier in 2024.
Krishna, it sounds to me like you think there's maybe some more work to be done, though, from the Federal Reserve before we get to that point. Are you anticipating another move from them, perhaps, potentially in November?
I still think so. I think the JOLTS report and everything else is helpful, but I think we have lots of other data points that are probably going to take them on the other side, CPI being a prime example of that. And if you look at the Cleveland Fed nowcast, it's definitely pointing upwards rather than lower. I don't think they singularly focus on that. So September is probably not in play, but saying that November is totally out of the picture, I think maybe a little premature.
The Doves have a better hand, I think, in the minds of many, going into that FOMC meeting on the 20th September. Kelsey, where will they be in November?
We think that they will still be on hold. And the reason for that is when we look at the trajectory of the data, the totality of the data, first inflation, then labor market, and then secondarily the GDP data, we think that they are going to be getting confirmation that policy is sufficiently restrictive. And to start off, it really all starts with the inflation data. We think inflation is slowing, and when we look at what's coming in the pipeline, we think that there's more disinflation to come. There's one index that has not really gotten a lot of press recently, but the Cleveland Fed has a rental index, repeat rental index for new tenants, that just turned negative year over year for the first time since 2010. So it didn't even turn negative during COVID. And so the reason I bring this up is a lot of people are talking about the rebound in home prices as being this signal of the fact that policy impact is behind us and that we could be seeing this rebound in the housing market. We would really push back on that. First of all, the housing prices are not a direct input into CPI and PCE. But secondarily, when we look at the activity measures, the Fed can't control supply. What they can control is demand. And boy, have they done a good job stifling demand for mortgages. Mortgage applications are at 2-decade lows. Mortgage rates are at 2-decade highs. Mortgage affordability, home affordability, is at the lowest level since at least 1984, according to the National Association of Realtors. So I think what we're seeing is fairly clear in terms of the trajectory of the economy, that they won't need to do another rate hike in November.
Kelsey, there's a ton of people who think they've done a terrible job when it comes to the housing market because they're on the wrong side of it right now. I'm one of them. Krishna, do you think we can ignore the house price data given how distorted that market is?
Well, so I think you can't ignore house price data. I think house prices are very, very high, and they are unlikely to come down anytime soon. And this is something that we will have to deal with for quite some time. I think the key point here is new construction is still quite robust. And that matters for activity far more than mortgage applications for resales and things like that. So I think the housing market, the housing affordability is a long-term problem for the U.S. economy. But for now, new construction remains supported. The point in all of this discussion isn't, are we making progress? Of course we are. That's why we expect things for the Fed to pause. The question really is, are we making progress fast enough to what they have articulated, what their long-term target is, which Powell reinforced at Jackson Hole, which is 2%. And if that is the North Star that they're shooting for, then it is very unlikely to see that this pause ends up being a short pause. I think for it to be a short pause, a lot of things have to together start slowing down. It may happen, but it doesn't look like that right now.
Yields lower this morning, right now, down by 5 or 6 basis points, 4.84 on a US 2-year. We had 6 consecutive sessions of closing above 5% on a 2-year. That ended yesterday with a breakdown off the back of recent data. Yesterday, job openings. This morning, that move encouraged again by what we had from the ADP report. Tomorrow, jobless claims. Friday, we get payrolls. Mike McKee has more. Morning, Mike.
Good morning, John. Well, ADP does come in a little bit lower than expected, but much higher than it has been in recent months. 177,000 jobs added to payrolls, according to the payroll processor. But take a look at the chart. And here's what's interesting about that. Look on the left-hand side, the blue lines. That's non-farm payrolls, private sector jobs, which is the equivalent of ADP. And for the last year or so, they were running stronger than ADP. But in the last 4 months, ADP has come in higher than non-farm payrolls, which creates perhaps a risk for Friday in terms of private sector job creation. We also got GDP today. GDP revised down just a little bit to a 2.1% from 2.4%, still maybe above trend growth. But the contribution was all in consumer spending this time. Consumer spending added 1.1% and business spending 0.8%, while inventories and trade subtracted. If consumer spending remains strong, that augurs well for the third quarter, and we will get a consumer spending report tomorrow for July, the first month of that third quarter. The road ahead is going to be long. September 20th is the next Fed meeting, and as you can see, we get a jobs report, PCE and CPI. Same thing before November. So if nothing really changes in the data, we may have a pause in September, but there'll be a lot of data for the Fed to consider for November, and that could be if we see a rebound in prices. That could be when they make a decision to raise rates again.
Mike McKee, thank you, sir. This narrative, oh yeah, just whipsawed from one narrative to another. It could change again on Friday with the payrolls data. Mike, thanks again. Mike McKee there on the latest economic data, looking ahead to the Federal Reserve and payrolls on Friday. Kelsey Barrow, I caught up with Ian Lingen of BMO in the last couple of hours, and I said, is this Treasury market for you, given what he was telling me about the economic data, a screaming buy? And he said the 10-year was a screaming buy. Kelsey, do you agree with him?
We do think that there is value in fixed income at these yield levels, and we do find it encouraging that we did test the highs reached in October of last year on the 10 and 30 year, which were 4.33 and 4.42 respectively. It was an uncomfortable ride, but we have rejected those levels and we are finding support. And when I look at the performance in the Treasury auctions specifically, the non-dealer takedown is very, very strong. So I think that there are a lot of people who are looking at this market and are saying, these are the highest real yields in multiple decades, and this is really an attractive time from a risk-reward perspective to be investing in fixed income.
Krishna, you said repeatedly over the last few months on this program that pain trade was higher yields. Are you sticking with that view?
Yes, for now, I'm sticking with that view. I think 4.5 is probably the upside range in 10 years. So the point about whether treasuries and fixed income are good value or not, they certainly are. I think from a, let's say, a 2, 3, 5 year investment horizon, can we look at these treasury levels and say that things will work out really nicely? I totally agree with that. The challenge is they can become better value if they go to 450. That's really the point. It's a trade rather than a long-term valuation judgment on 10-year treasury. At the current levels, they're very attractive for sure for long-term investors.
Well, Kelsey, it's good news. Krishna's got some bonds to sell. We're making a market here. Kelsey Barrett, Krishna Mamani, sticking with us. Your equity market on the S&P 500 just about positive by 0.1%. 3 days of gains on the S&P, looking to make it day 4 with some price action going into the opening bell. Here's Simone.
Yeah, even though futures pointing modestly higher, most of the biggest movers are on the downside. One that's up, though, is NVIDIA. This may be on the back of some Bloomberg reporting about some of the analyst estimates here. Rosenblatt Securities' Hans Mosesman now has a price target of $1,100, up from $800. That would indicate a market value of more than $2.7 trillion. And, of course, those shares just at $491, so a big upside. To the downside, HP setting up its largest loss in about a year after earnings yesterday. The company cutting its full-year outlook. The message, rebound in the market for PCs is going to take longer than anticipated. And one that's really interesting as well, Brown-Forman Corp. So this is the parent of Jack Daniels and Woodford Reserve. It posted a surprise quarterly profit decline, but did maintain its full-year outlook. It said whiskey sales fell slightly, but the good news was in tequila, up 15% year on year.
That's always good news. Simone, thank you. More from Simone around the opening bell. Coming up, Eurozone inflation leaving the door wide open for another hike.
To the ECB, we've always said that they've been behind the US. I think that you've got another rate hike coming out of the ECB, particularly given what you've seen on the inflation side coming out of parts of the euro area.
That conversation coming up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
To the ECB, we've always said that they've been behind the US, have been watching what the US is doing. They're also being data dependent, just like the US Fed. And I think that you've got another rate hike coming out of the ECB, particularly given what you've seen on the inflation side coming out of parts of the euro area.
Inflation prints out of Spain, out of Germany, showing consumer prices still heading in the wrong direction. The data is just the first in a string of Eurozone reports that will dictate whether ECB officials raise interest rates in a couple of weeks' time. Maria Tadeo joins us now for more. Morning, Maria.
Good morning. And look, this is a mega data-dependent central bank. So let's get into the data that we got today. When you look at Spain, inflation came in at 2.4% in August. It was in line with the estimate, but it did pick up from the previous month when it was 2.1%. When you look at Germany, again, this is the biggest economy driving the euro. You have inflation at 6.4% in August. The estimate was for 6.3%. So economists were expecting a faster cool down. Now, of course, we should make it clear we're waiting for the French CPI, the Italian CPI, and of course the big euro area number for August. But again, if you assume this trend will continue, if inflation either stuck or actually ticking up, you could argue it brings back fully on the table that September rate hike. Because remember, the ECB said they could hold or hike. It would depend on the data. But the fundamental question for the central bank is not whether inflation is cooling down or not. We know it is. It's whether inflation is cooling down enough to merit a pause. Now, if you get that kind of inflation numbers, that trajectory is still strong, then you could argue there is a strong case now to keep that hike going into September.
Maria Lagarde, Christine Lagarde, the ECB president, super vague with TK on Friday in that interview in Jackson Hole. What are other officials saying about incoming data and what they want to see happen in a few weeks' time?
Yes, and look, there's a number of reasons why she does that. Obviously, she's repeated this is a central bank that is guided by the data. Maybe would have been a contradiction for the head of the ECB to swing either way without the actual prints from the euro area for the final August print before that decision, which will really be that final data point before they head into deliberations. Obviously, we know she's the head of the governing council, so she's supposed to be the one that brings in consensus or not take strong positions either way. Nonetheless, we do know from a number of central bankers, including the Germans, but also the Austrians, suggesting, yes, it's the data that matters. But again, the data would show whether or not we've done enough to really show the data is consistent with a cool down that would bring inflation back to target. So if you assume, and you listen to Nagel of the German central bank, you listen to Holtzmann of the Austrian central bank, they would say, looking at this data, it is still a good reason, or there is still a good reason to go for another hike in September. Maybe not convinced that this trajectory is moving as fast as the European Central Bank wants it to be towards that target.
Maria, thank you. The latest from Maria Tadeo out of Brussels today, heading over to Frankfurt, Germany on September 14th for that ECB rate decision. We've had a breakdown from the likes of Spain, Germany. Tomorrow, it's the headline Eurozone read for inflation, CPI, headline and core, coming tomorrow morning. Kelsey Berrow, we talked about the door being closed potentially for the Fed to hike in September. Is the door open for the ECB?
Well, the door is probably still open, but really only marginally so. We think that the ECB is in a really tricky place because when we look at the survey data and the activity data and the PMIs, and the ZEW, they're really all very, very weak. And so I'm surprised that we're not hearing more about the word stagflation in Europe. I mean, they still have a lot of inflation, but growth is definitely on a rickety path right now, I would say. So the ECB is probably going to want to bide as much time as they can, maybe skip in September, continue to remain data dependent. But when we look at the fundamentals on the growth side, it's not looking great there.
Krishna, stagflation, is that the right word to use to characterize what's happening in Europe right now?
Yes, I think, and Kelsey is absolutely right. Between the jobs of ECB and Fed, the Fed is in a significantly better position. The challenge for the ECB is the growth outlook remains extraordinarily weak. And inflation is slowing down, but not slowing down fast enough. And so what do you do about that? And I think my sense would be that to maintain their credibility, and I know it's a strange word to use these days, to maintain their credibility, they probably end up doing something rather than not doing something.
Krishna, how does a bond market trade in a stagflationary world? What do bonds look like? What do BTPs look like, Italian bonds? How do those bonds trade in that kind of world?
Well, so my expectation would be that stagflation would really be a temporary situation rather than being a long-term problem because of structural reasons. So if that is the thesis and if that holds up, I think the bond market trades just fine. It may not do very well in the near term because of inflationary pressures, but from a longer term perspective, the growth outlook is, given all the issues that your Eurozone faces, the likelihood that the growth outlook improves meaningfully and inflation remains as elevated for a long period of time, I don't think that's that's a possibility. So it should trade fine. It's just that there'll be a digestion process along the way.
You've got to throw in the China slowdown into the mix as well. A range of efforts over the weekend to try and do something about this equity market, cutting stamp duty on equity trading for the first time since 2008, stock purchases, leaning on some funds to buy equities, buy more than they're actually selling to try and put a floor under that market, cutting mortgage rates, deposit rates, all of these efforts, Kelsey Barrow, to stimulate the Chinese economy. Europe's got to confront that as well. You said the Treasury market with a screaming buy. You said that about 5-10 minutes ago, agreeing with what Ian Lingen of BMO had to say. Can you say the same thing about the European fixed income market?
We do think that ultimately this challenge that the ECB is facing is going to be reconciled with slower inflation and slower growth. So as Krishna mentioned, this is a temporary situation. And so ultimately, Europe is going to be another area where we can be diversifying our long duration position, not just in the US, but also with boons. I think you made a good point in terms of the situation with China. That is going to have bigger pass-throughs in Europe than it is going to in the US. But the one thing that we have been highlighting is that emerging markets outside China are actually holding up quite nicely. And one of our top trades for the year was EM local debt. And we've seen a lot of satisfaction there because the disinflation story in emerging markets has generally come out as anticipated, and you have emerging markets that are actually starting to cut rates. They started hiking ahead of the Fed, ahead of the ECB. They're now actually starting to cut rates. So there's opportunity to be long fixed income in multiple marketplaces right now, not just the US.
Kelsey, will you do me a favor? Can you tell Bob it's rude to make you work on your birthday? Okay, tell him from me. Happy birthday. Kelsey Barrow, Chris Mamani, to the two of you, thank you. Going into the opening bell, about 7 minutes away from that opening bell. Equities just about unchanged on the S&P. Your morning calls are up next, and later, Keith Lerner of Truist on why investors shouldn't fear the recent equity pullback.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
5 minutes away from the opening bell. Equities just about unchanged on the S&P. That's the price action. Here are some morning calls for you. First up, Bank of America raising Alphabet's price target at 146 from 142, seeing cloud and AI projects as positive drivers. Next up, Bernstein downgrading Texas Instruments to underperform, seeing gross margin expectations appearing, quote, far too high. And finally, Wedbush raising its Best Buy price target to 82 from 72, citing recent earning results that topped expectations on the top and bottom lines. Coming up, Keith Lerner of Truist on why he views the recent market pullback as a healthy reset. Your opening bell up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
So far, so good on the data front. 3 days of gains on the S&P 500. Longest winning streak of the month so far. Biggest day of gains yesterday for August. Biggest day of gains on the S&P 500 going back to early June. Right now, futures totally unchanged on both the NASDAQ and on the S&P 500. Let's the opening bell, switch to the board and get to the bond market. Yields shaping up as follows on a 10-year. Yields lower by a couple of basis points. 4.0983%. In the last week, I think just last Tuesday, we were through 435. In the 430s, all the way back down to about 4.1% on a 10-year this morning. In the FX market, dollar weakness, euro strength, 109.27, positive on that currency pair by 0.4%. And in the commodity market, a lift here of 55 cents, up by 0.7% to $81.04. and about 71 cents. About 30 seconds into the session, advancing here by 0.1% on the S&P. On the Nasdaq, up by almost exactly the same amount. One stock to watch at the open, HP. The company reducing its full-year cash flow and profit outlook. The CEO saying this: while we expect another quarter of sequential growth, the external environment has not improved as quickly as anticipated, and we are moderating our expectations as a result. Simone has more. Hey, Simone.
Hey, John, yeah, this is the biggest loss since last August as the company cutting its full-year outlook. Analysts had been looking for some sort of sign that there was stabilization in the consumer electronics market, but they, in fact, particularly called out a bunch of the weakness in the enterprise space around printers. Seeing net revenue down 9.9% year-on-year, that was more than anticipated in the last quarter. Trimming that full-year profit forecast, as I mentioned, now $3.23 to $3.35 per share. They had seen $3.30 to $3.50 per share. The Wells Fargo talking about how there was structural demand and competitiveness issues, calling the outlook for the company particularly bleak. The CEO there is still confident that a rebound will happen, but certainly less accelerated than they expected a quarter ago, John.
Simone, thank you. The stock's at 28. It's down 9%. Deutsche Bank lowering the price target on HP to 28. That's where we are right now. They've gone down to 30, citing weaker demand driven by slow recovery in China, elevated channel inventory in PC, and cautious enterprise spending. Have they lowered that price target enough? Right now, 28, 29. Their price target is 30. I want to turn to EV. Tesla facing increased scrutiny from federal regulators over its driver assistance system known as Autopilot. One agency saying Tesla has introduced a configuration that, when enabled, allows drivers to operate their vehicles for extended periods without it prompting the driver to apply torque to the steering wheel. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla down more than 1%, but remember, it closed up more than 7% yesterday, its biggest jump since March. Remember, NHTSA's had a probe on Tesla's Autopilot since 2021. This particular inquiry from the regulator, the National Highway Traffic Safety Administration, relates to a report back in June that there was a specific setting on Autopilot that simply allows the driver to maintain hands-free without applying a periodic pressure to the steering wheel, something which is not, frankly, permitted in at least the United States. We know that Tesla responded to that NHTSA request for information by NHTSA's deadline, but it was in confidence, so we don't know what Tesla had to say. You know, there's a lot of focus from a regulatory perspective on it, simply because Tesla is a technology leader. And, you know, there's momentum around autonomous driving technology, but the regulatory scrutiny is essentially a headwind to growth, right, and continuing to monetize that product. Separately and kind of more broadly, as these UAW discussions continue with the Detroit 3, our colleague Joel Levington on the credit side at BI has a really interesting note out about how Tesla could use the opportunity of that chaos to continue using price cuts as a lever, because it's immune to what's happening in those UAW discussions. So I just want to point that one out, as it's some good reading this Wednesday morning.
Yeah, well flagged, Ed. Just where are we right now with those negotiations going into the end of that contract next month?
Yeah, look, simply put, the UAW is going to the automakers and saying, hold on, how can you in good conscience say you cannot afford our demands when you are combined spending as an industry $100 billion to electrify your product line? Their basic argument is that the capital commitment that the automakers have made to transition to EV is at a similar scale to what they're demanding in terms of pay increases. So, you know, negotiations ongoing, but I think what they're looking up for, a 45% rise in wages, the automakers come back and say, not right now.
Ed, thank you, sir, for the update. Ed Ludlow from the West Coast on the automakers and Tesla specifically there. About 4 or 5 minutes into the session, day 4 of gains on the S&P, up 0.2% on the S&P. Want to turn to crypto stocks. Coinbase in focus after Grayscale won a key legal fight. It is pushed to launch the first spot Bitcoin ETF. Grayscale saying this in a statement: this is a monumental step forward for American investors, the Bitcoin ecosystem, and all those who have been advocating for exposure through the added protections of the ETF wrapper. Katie tracking the story. Morning, Katie.
Katie.
Morning, John. Yeah, Coinbase shares currently wavering this morning after a 15% rally yesterday. Like you said, that follows news that an appeals court sided with Grayscale in their lawsuit against the SEC. That was seen as a big step forward in the path to a U.S. spot Bitcoin ETF. And that matters for Coinbase, given that in addition to being a crypto exchange, how you probably know it, Coinbase is also a custodian for Grayscale's Bitcoin Trust. It's also lined up to service a number of the active spot Bitcoin ETF applications currently in the SEC's queue, including BlackRock's application. Now, the custody business has been seen as a bit of a silver lining for Coinbase here, given that its crypto trading volume has fallen off a cliff and stayed there over the past year or so. There is debate as to how much that institutional business can really buffer the bottom line if we do see volume continue to remain muted. But even with those question marks, Coinbase shares up almost 140% this year alone, John.
What a move. Katie, thanks for the update on that story. Just a programming note to continue this conversation. Next hour, 10:45 Eastern Time, so about an hour from now, actually, the Grayscale CEO, Michael Sonnenschein, speaking to Bloomberg's Shanali Basak. Don't miss that conversation a little bit later this morning, 10:45 Eastern Time. I want to turn to the chip makers. NVIDIA announcing a new partnership with Google Cloud that could expand distribution of its AI technology. The CEO saying, quote, "Our expanded collaboration with Google Cloud will help developers accelerate their work with infrastructure, software, and services that supercharge energy efficiency and reduce costs." Isabel Lee has the story. Hey, Isabel.
Hey, John, investors definitely took that as good news. The stock closed at a record during that data it was announced. But as you can see, the stock is now kind of flat. But still, even if NVIDIA's spectacular rally has slowed somewhat, we have a lot of investors still bullish on the stock. In fact, there's one I want to bring your attention to, Rosenblatt Securities. So they increased their price target of NVIDIA from 800 to 1100. And if achieved, this would make NVIDIA's market value up to 2.7 trillion. That would rival Apple's 2.9 trillion. So Rosenblatt said NVIDIA's just getting started. He's really raising it on the back of expectation that NVIDIA will increase supply in each quarter through next year. NVIDIA is up some 234% year to date, and it's by far the best performer in the S&P 500. But not everyone is as bullish. Out of the 60 analysts Bloomberg surveys, we have 4 who are rating NVIDIA as hold, John.
Isabel, thank you. That stock, a ridiculous run through 2023. Your broader market, slightly positive on the S&P, slightly negative on the NASDAQ. Keith Lerner of Truist given his perspective on markets over the last month, saying August has been less friendly to investors. Our view is simply that after 5 straight months of gains, the market became overextended on a short-term basis. We view the recent step back as a healthy reset of expectations. Keith, I'm pleased to say, joins us now for more. Keith, August, you say a tough month. I had a guest earlier this week called September a slippery slope. Would you push back against that, Keith?
Well, historically, that's right. I mean, the seasonal trends tend to be negative in August and September. There's only one thing to look at, right, seasonal trends, but we will get into, I think, a lot more, news from Washington as we think about a government shutdown potential as well. So I still think it will be choppy, but, going back to the border point, Jonathan, which you just alluded to, is that, we did have these big gains coming into July, and what we saw is that expectations had risen, right? The bar for positive surprises had risen quite a bit, and we saw sentiment become much higher as well. So our view coming into August was it was going to be a choppy period and likely to see some type of corrective period. But the good news, in our view, we published a note last week calling it a healthy reset, in that we've seen sentiment come in on many of the metrics that we look at. We've seen that as the market has come down before the last couple of days, the earning trends for the market is now at a 52-week high. So we think that's a positive as well. And overall, I think the economy is still proving to be somewhat resilient near term. So overall, I think you got to respect the trend. And the last one I'll say, from a technical basis, you came down towards support, you came down to an oversold condition, and you bounced. So that's a healthy sign that you want to see on pullbacks.
Hey, Keith, let's talk about the data and whether the progress we're making is healthy or not. We had job openings yesterday come down, quits level drop. This morning, ADP downside surprise, tomorrow claims, Friday payrolls, the 13th we get CPI, the 20th the Fed decision. Do you think we're making progress quickly enough? Krishna Mamani in the last hour said we're not. Do you agree with him?
I think we are making pretty good progress, especially relative to our expectations coming into the year. If you think about like the ADP report this morning, let's say the Friday print is around the same level, 175. I mean, obviously it's a wild card. But if you go back to 2019, the average job growth that year was about 160,000. So, you know, we're in this tricky part where you're coming down from really elevated levels and you're normalizing the data. I think the concern at some point later this year is if it starts to come down too quick. But right now, I mean, the way we're looking at it is at least short term, it's more of a normalization. And, you know, 175,000 payroll is still enough to keep the unemployment rate relatively low.
Well, Keith, I mentioned that a little bit earlier. Let's really try and paint that picture with some detail. How fine is that line between progress and undesirable deterioration? How fine is that line?
Oh, it's a fine line, Jonathan. You think about when people this debate around economic growth right now. You know, if you're looking at manufacturing data, leading economic indicators, the yield curve, everything there points towards a recession. You look at unemployment, initial claims. You know, the services side is still showing relatively strong. We all know the Atlanta GDP, which is overstated. You guys talked about it this morning, is around 6%. So I do think as we go later in the year, what's going to cause, you know, a different market than the first half is that fine line is going to show, like, some data points are going to confirm that the economy seems fine, and then we're going to see other data points that show the opposite. So I think that's going to just lead to a much more choppier market. And I think from our perspective, the way to deal with that is you buy oversold conditions, and if you're being more tactical, you sell, you know, you sell the rips in some ways as well.
Let's pick a sector. I'll paint a really bearish story for you, and you can tell me if you're on the other side. Consumer confidence down, jobs market easing, retailers, pick any retailer right now. I can give you a bunch of them warning about something. There's a long list of things they've been warning about, Keith, over the last week into the rest of this year. Keith, what is there to like about consumer discretionary with all of that going on?
Yeah, so it's an interesting sector because consumer discretionary, when you look at what's actually driving the biggest names in there, it's like, you know, Tesla and Amazon. So I call it a quasi-growth sector. So I think those growth areas are the areas that we still like, but to your point, it's very bifurcated. And I don't think those other areas that you mentioned are going to be leadership. I mean, I do think we're going to see some slowing in the economy. I do think the lagged effect will hit at some point. And, you know, even by the way, the Fed just put out a new study this week that suggested that, you know, the lag for corporate interest rates hitting, you know, works with about a 5-quarter lag every time you raise rates by 100 basis points. So I think we're going to see more of a hit there, especially as some of the excess savings as well for the consumers. But I would focus more on the growth side of consumer discretionary, just like, you know, another area that we like is communication services, which is also more of a growth area as well.
Keith, can I squeeze in energy as well? One of the rare sectors this month, so far month to date, that's actually positive through the month of August. Last time I checked yesterday evening. This is all happening, even with this slowdown in China and seemingly their inability or unwillingness to respond to it with force at the moment. Keith, what's driving that story for you?
Yeah, you know, it's interesting. All the points we're talking about is this bifurcated overall market, and also like the traditional playbook isn't working right now. But going specific to energy, you know, we went negative early in the year. We upgraded to neutral. I will say the overall trends are somewhat improved. I think the supply, you know, cutbacks is a positive. And the other thing, a lot of these companies have a lot of good cash flow generation. So we also have to remember last year was a big year in energy. A lot of people were very bullish. You're working off some of that bullishness now. So we're not overweight yet, but we're watching it closely for an upgrade. We're just being patient at this point.
Keith, appreciate the patience and the update as well. Keith Lerner of Truist on the latest. Thank you, buddy. It's good to see you, sir. About 13 minutes into the session, equities up by 0.2% on the S&P 500, potentially fourth day of gains on the S&P. That would be the longest winning streak going back to the middle of July and follows the biggest day of gains since early June on the S&P 500. Coming up, Secretary Raimondo talks business in China as Huawei-Apple competition ramps up.
The U.S.-Chinese economic relationship is large, vibrant, and dynamic, and that benefits both of our countries and economies, and that benefits the world. There's business we can do, and there's business to be done.
There is business to be done. Your team coverage up next.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this. I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just a timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Business we can do, and there's business to be done. U.S. businesses want to do business here, but they need to have a predictable regulatory environment. Nothing good comes from shutting down communication. What comes from lack of communication is misassessment, miscalculation, and increased risk. Nothing good comes from decoupling.
There is business to be done. Secretary Raimondo in Shanghai pushing for a stronger regulatory backdrop in China. This on the heels of Huawei's surprise release of its new smartphone, sparking hopes that Chinese firms can overcome US sanctions and curbs. The launch coming just weeks before Apple is set to unveil its iPhone 15. Your team coverage starts right now with Ed Ludlow alongside Anne-Marie down in Washington. AMH, just how tense are things right now between the Commerce Secretary and Chinese officials?
Well, she really tried to walk this fine line, Jonathan. We heard her say that commerce and trade could be the bedrock of this relationship, which potentially could help decrease the tension we've seen from Washington and Beijing, and also provide opportunities for the Chinese economy that looks like they would need it right now. But of course, when it comes to China, they are incredibly concerned about the export controls coming out of the United States, and it's her agency that is leading that charge. And then you wake up and you see what's going on with Huawei. Potentially, China is getting around some of these curbs that the U.S. has applied to it. I mean, Huawei has been on the entities list during the Trump administration since 2019. So how are they able to potentially get this technology while there are sanctions on that company? That is a question, and that is why it's also very awkward that this phone came out and was launched seemingly today, and she's headed back to the United States.
This is fascinating. Breathe some life into this conversation. How much competition might there be for Apple domestically and beyond?
Great setup by AMH, because it's a technology story as well. You know, unverified reports, and Bloomberg's not been able to verify them. I want to make that clear. But the Mate 60 has seen a number of Chinese outlets do teardowns, and they went right to the processor. The processor indicates that it was manufactured using 5 nanometer node technology. To the best of the industry's knowledge, China has itself not been able to crack 5 nanometer meter node technology, which is only one generation prior to the cutting edge, which is 7 nanometer, right? So the reason I say that is because it's been on the entities list since 2019, we know that Huawei had stockpiled TSMC-built chips at the cutting edge. It raises a lot of question about how much progress they've been able to make, not just on their own chip design front. HiSilicon, their chip arm, is by reports the designer of this chip. But if they've been able also to work out the fab side of this equation, then you look at the stock reaction overnight across a number of Asian and Chinese suppliers, there is an indication that they'll be able domestically to make their smartphone market more competitive, which goes back to Apple, because Apple always sees China as such a key market.
So, Ed, how big is this iPhone launch in a few weeks' time?
Yeah, I think it's big, and you know, iPhone 15, as Mark Gurman always writes, you know, it depends generation to generation on the substance of the hardware upgrades. We expect big hardware upgrades. Think about the bigger picture here in Apple's most recent earnings. We know, Jonathan, that significant technology upgrades drive a refresh cycle, which is important for the company, but it is also important to spur consumer pockets of demand globally.
Ed, thank you, buddy, for the update. Ed Ludlow there and Anne-Marie. Fantastic setup from AMH, as always, on the latest between China and the United States. And a really fantastically interesting technology story on the tech front in China. I would say the competition for Apple domestically in China, what happens from here for them? Difficult, tough time for them with sales of the iPhone. Let's see if the 15 changes that. About 22 minutes into the session, equities up by 1/3 of 1% on the S&P, up by 1/4 on the NASDAQ. Let's lift the lid on the index, get you some sector price action. Here's Simone Foxman.
Yeah, tech has been so much of the story so far this year, but it is not the main story today. Energy, industrials, and healthcare leading the way when you look across the markets at different sectors. Energy, we've seen one of the two sectors that is positive on this month, with WTI largely flat since the beginning of August. We're watching financials here as well. This particularly after news that Visa and MasterCard are planning to increase fees that merchants pay to accept customer credit cards. Those are set to start in October or April and will bring in about $500 million more in fees. But one I really want to highlight here is healthcare. Again, one of the two sectors that has been positive on this month. Holding steady today, even though we had that news yesterday on the Biden administration and announcing 10 drugs on which it's going to negotiate drug prices with Medicare. But Eli Lilly there, I think that's the highlight for the month, among the best performers, over 20% up since the start of August.
Simone, thank you. Thanks for that. Looking ahead to next week, through the rest of this week, I'll bring you the trading diary. So far this week, so far, so good. Job openings aggressively lower. Then we had ADP, downside surprise. Tomorrow claims, payrolls on Friday. And when I say so far so good, I'm talking about from the Fed's perspective. This is the outcome they want to see. Further progress to keep that door shut to further hikes on September 20th. Your trading diary up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
At 25 minutes into the session yesterday, biggest day of gains on the S&P since early June. Today, potentially a fourth day of gains on the S&P. Right now, equities up by 0.4%. That's the price action. Here's the trading diary coming up. Home sales coming at the top of the hour on Thursday. Another round of jobless claims and the PCE deflator. Friday, the main event, the U.S. payrolls report. And remember, Monday, U.S. markets closed for Labor Day. Before we get to Monday, sneak peek of Friday, the estimates so far in our survey, the median estimate, 170,000, just down from 187. From New York, that does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning, or Wednesday morning. Holy cow, Wednesday morning. Here we go. I take a day off and it gets totally discombobulated. Wednesday morning here, Bloomberg Interactive Broker Studio. Coming up, we're going to check in with Jennifer Lee. She's a senior economist at BMO Capital Markets. Get her thoughts on some of this eco data we've seen over the last couple of days and how that might influence the Fed decisions in the remainder of this year. Plus, Odetta Kushi, Deputy Chief Economist at First American, discusses kind of the mortgage market, the residential housing market. Is anybody selling their house these days in a world where we've got a 7.5% mortgage out there? Let's kick things off right now with John Tucker in the Bloomberg Business Flash.
Well, let's start right there with pending home sales. This is secondary, maybe even tertiary data, but pending home sales month over month coming in a lot better than we had expected. 0.9%. This is again on a month-over-month basis. For the month of July, we were looking for a 1% decline. More data this morning earlier that point to economic softening. You had private payrolls measured by ADP that increased, but less than expected. And also GDP rising at a revised pace that was below the government's previous estimates. So that's pushing yields lower. The more policy reactive 2-year yield, 5 basis points lower. The yield at 4.84 right now. 10 of the 11 major industry groups in the S&P 500 higher. Katrina Dudley at Mutual Series among investors who think the Federal Reserve is done with its cycle of rate hikes.
I think we've closed the door to a September Fed hike. I think that one's fairly well shut and in the rearview mirror. We're now talking about 56% odds of a rate hike in November. That's as good as a coin toss.
HP among the individual shares most active, profit outlook cut, acknowledging PC demand isn't coming as quickly as hoped. The rebound there. S&P 500 right now 20 points higher. That's up 0.5%. We're at 45.18 on the index. Dow Jones Industrial Average up 147 points. That's up 0.4%. The Nasdaq 100 right now 66 points higher. That is up 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Metten.
Always
today.
A pleasure.
Always a pleasure. Good stuff here. Jess Metten, Paul Sweeney. We're here live in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So just head over to youtube.com and search Bloomberg Radio. So we got a little bit of green on the screen here, as John was just reporting.
Also looking
like
at
that.
home builders in the S&P 500, they're
What are they
actually
doing?
that sub-industry group up more than 1%. We obviously know they've been on a tear this year, but on the back of the pending home sales data, JT was just talking about unexpected rise there, but you were just mentioning, obviously looking at mortgage rates up north of 7%, the highest level they've been since the turn of the millennium there. Obviously, when you're looking at those high rates along with limited inventory, curbing that demand, but interesting surprise there with that data.
And they're building. I mean, there's not a lot of existing inventory come on the market. So if you want a home, you got to go to a newly built one. And these guys, I guess they can't build them fast enough.
And that's why a lot of portfolio managers I speak with have been more bullish on home builders just because that continued lack of inventory.
Yep, good stuff. All right, we'll get to that later. Right now, let's check in and see what's happening underneath the hood for these equity markets. We do that with Bloomberg equities reporter Nora Melinda. Nora, what are you looking at here?
Yeah, so looking at a few things this morning, of course, we did just have pending home sales come out, and of course that was on the surprising end. But obviously this is a leading indicator, and it tends to be a little bit more reliable than housing starts due to weather being a factor. And of course the expectation was down for 1%, but we're seeing 0.9%. So that's a nice surprise. But in the equity space, looking at HPQ, so of course that stock has actually fallen the most in 3 years on tepid PC demand. Essentially, they said that the rebound in personal computer demand isn't coming as quickly as hoped. And we do know.
I forget because they separated HPQ from HPE.
Yeah, and
Q was kind of the PC part, and E is more the enterprise.
Right, so the
software.
enterprise hardware products are
Gotcha,
for
okay.
HPE, the servers, networking equipment. Then you've got the desktop PCs, laptops, printers, all housed under HP.
Q.
Sounds
Yes,
like an
HPQ.
investment banker got in there and
Right.
said,
So
"Hey,
that
let's
happened
split
back
it up."
in 2015 was the split.
Got it.
But PC makers as a whole have really been struggling to stage a rebound, a comeback since sales fell off a cliff after the pandemic. So, there is the CEO did cite that, an analyst did mention that although it is a tough market environment, the rebound has started to happen. So he's kind of using that as support, but overall that stock is down this morning.
The Sweeney household just purchased a new PC for the youngest offspring who's going away to college.
Back to school.
Back to
there we
school.
go. That was something they were banking on, and obviously looking
think
ahead
so, yeah.
to the holiday season. But it's interesting with Hewlett-Packard Enterprise, they actually boosted their annual profit outlook. So it seems like on the server networking equipment
makes
side
sense,
of
I guess.
things look a little bit brighter than when
Right.
you're looking at the PC side.
Right. So not as terrible on that side as you mentioned, but HPE is still kind of falling in sympathy with HPQ. So really interesting stuff there. But let's talk about the hurricane.
Yes.
So we have Hurricane Idalia. Of course, it made landfall in Florida around 7:45 this morning. Starting as a Category 3, but has since kind of receded to a Category 2. But there's lots of stocks in focus, different sectors ranging from construction to engineering, insurance, and utilities. Looking at stocks like NextEra Energy and Duke, but also airlines are in focus. So there's quite a few sectors that could really be sensitive to such weather impact.
I'm looking at just a story that kind of gets my attention, being the media person. Warner Brothers Discovery has named Mark Thompson as the chief executive officer of CNN, and he was the former leader of the New York Times and the BBC. So I guess his job here is to steady the cable news channel after a period of upheaval. And this guy is a serious player within the media space,
Right.
within the news space.
And you covered a lot of these companies in your day on the sell side.
Yeah, I'm looking at Warner Brothers Discovery again. That was Discovery Communications and kind of mushing itself together with the media assets of Time Warner that AT&T disposed of. The stock's up about 1% today, but it's up 38% year to date. People hope that they can that there's good value and good free cash flow there. But so at least that's maybe a little bit of a steadying move there for the folks at CNN.
Right. Salesforce, CrowdStrike, Okta all report after the closing bell. So that's something I'm going to keep my eye on as far as the tech side of things later on.
Yes.
Yeah, Salesforce, big name.
But I did want to just quickly pivot to the exercise space, looking at Peloton.
Oh, here we go.
Oh, this is
right up my alley.
I was going to say this is right in your in your territory.
Paul's got an office with the treadmill and the bike.
I love it. I love it. Well, Peloton is down more than 4% today. I know.
Yep.
Bummer. But Macri actually cut its rating to neutral from outperform. The analyst has said that weak results make a successful near-term turnaround very less likely. But they do still see potential for the company to turn things around, but the path forward has, quote, just become less clear.
Yep, it's a tough one. They went crazy selling the bikes. They couldn't make them fast enough. In fact, they built too many of them and stretched it. Then they had an inventory problem. And now they just don't have the demand that they had during the pandemic. So how do you right-size the company? That's kind of the story. And they've had management changes and so on and so forth.
We've talked a lot about how the commercials, obviously, you see less of the bike and more of the other products that they're trying to push.
Yeah, exactly. And again, my personal thing, and I don't know how you do this, but I've seen it from other businesses, you do have a group of subscribers that are just passionate about Peloton.
Right.
You have to figure out a way to monetize that subscriber group, that level of passion. I don't know how you do it, but you got to figure out a way, and that's kind of where they are.
And the question is it really just a pandemic thing, or are people still, into Peloton to that same extent?
Well, I know that, Paul, you like to go to the classes, but you also had the issue of how do you get one of your units to a different
Yeah, we're going to have
house.
to pay some...
Right, how do you
like John
transport
Tucker
this?
he's got a pickup truck.
Can't you just ride it to somebody else's house?
It's the bicycle.
If only.
It's the bicycle to nowhere. So that's kind of how they call it.
Bicycle to nowhere.
So I need to find an
I love that.
intrepid
It's a very,
young person.
very
The bicycle to nowhere.
I like it.
Expensive clothes hanger. All right. Very, very good. Appreciate it. Nora, Melinda, thanks so much for joining us. Nora covers all the equities for Bloomberg News. I want to get to our next guest, Jennifer Lee. She's a senior economist and managing director at BMO Capital Markets. Jennifer, lots of economic data this week, and likely will have an effect on what we hear from our Federal Reserve in the coming months. What are you looking at this week in terms of the eco data?
Good morning, everyone. Thanks for having me on. Sorry, I'm still laughing about the bike to nowhere. That's how I feel sometimes with
Yep.
the treadmill. So for this week, I think all the key numbers are coming out tomorrow, although this morning's reports on GDP was a little bit kind of interesting. Even though we saw that downward revision, it was all due to inventories and net trade, but I noticed that the consumer spending portion was still a little bit, just a smidge higher, which is kind of interesting. But tomorrow's PCE numbers, will definitely be key because it's going to show you how Q3 is beginning. Sorry.
That's interesting too, because this is a revision to that, and you are seeing consumer spending revised higher there. And those expectations, when I look at the ECFC function in the Bloomberg terminal that takes sort of the estimates for the average, what economists are expecting, you don't see even a quarterly contraction anymore coming up for the next few quarters. So when you do have so many economists expecting that potentially we could see a recession in the next few quarters, how do you square that away when you have data like this that's being revised to the upside?
So we are well, actually, it was interesting because when you look at the components, it was all durables that actually was revised lower. But again, there was upward revisions to services, and that's where all the demand has been. But we actually have a contraction for the first quarter. I had to look at my notes here. For the first quarter, actually, in around the turn of the year, because we are still looking for growth to slow overall. We're not looking for that hard landing that many were calling for, just a number of months ago. We're still looking for that soft landing, and so far all the data are pointing in that direction. Things are slowing, which is not a bad thing. This is what the Fed wants. This is what they really, really want. I think in terms of the consumer, just to have them pulling back a little bit and eventually just taking all the spending off the table at some point early in the new year will help, again, growth slow even further, but not have that hard landing.
So if there is not a hard landing here, how do you think the Federal Reserve will kind of interpret some of this data? Will they could very well pat themselves on the back, take a little bit of a victory lap, and just kind of stand pat for a while. Is that something you foresee, or do you feel like they may feel like they have more work to do in terms of pushing rates up a little bit?
It's all going to depend. I mean, it sounds wishy-washy, but that's, unfortunately, that is the case. Everything is data dependent. I don't know if they're going to be doing victory laps. I'm just judging from what Fed Chair Powell said last week. In Wyoming, I don't think they're doing any victory laps. They're still watching everything very carefully. He did, give a nod to the better inflation data of late, but he said it's just far too soon, and we already knew that. I mean, a couple of months of better inflation data are definitely not enough to have them be very, very comfortable. I think they need a lot more than that. But for sure, our official call is still that they are going to stay the course and keep watching the data and not do anything. And of course, there is a risk. I still think that the risk is to raise rates if things do not cool or cool more than they want or less than they want. You know what I'm trying to say. Of course, all the latest jobs data have been very interesting as well with the ADP this morning. I don't take too much stock in it because it's sometimes quite wonky compared to what the official data say. But overall, we have seen that slowing in growth, in job growth, in job demand, lower job openings out there, or fewer job openings out there. Still far more than the number of unemployed Americans out there. So it's still tight, but at least we're all heading in that right direction.
We talk so much about whether or not we'll see the Fed potentially raise at least one more time here. But what about just how long that they keep rates at an elevated level there? And how long are you expecting that to potentially happen?
So we are looking officially for the first rate cut to come probably sometime in the middle of 2024, so mid-year, so another year from now. We've actually been pushing that out a little bit more just because the data have shown that the U.S. economy is a lot more resilient than anyone would have hoped for at this point or expected. So if anything, they're going to keep rates for higher for longer. So I don't think, again, we're not going to see another rate cut or a rate cut coming until at the earliest middle of next year.
We're going to get, obviously, on Friday, the change in non-farm payrolls. Consensus is for a gain of 170,000. That would be down from prior period of 187,000. But unemployment rate kind of sticking around 3.5%. Where do you think that unemployment rate goes? I have no idea how this labor economy is working. We had the JOLTS number come down yesterday, but where do you think the unemployment rate ultimately goes?
Higher. If you had to pick a direction, it'll be higher, but not too much higher. Probably something in the mid fours, I believe we have. This is all to be expected at some point. Like when you have over 500 basis points of rate hikes coming from the Federal Reserve in such a short amount of time, at some point, again, we're already seeing that job growth slowing. The demand for jobs are also starting to wane a little bit. So we're going to start seeing that unemployment rate inch a little bit higher, but it's not going to be ratcheting higher. And at the same time, there's still demand out there for certain categories of workers. Maybe not, on a broader scale, but certain areas like construction, we're still lacking. Even on the technology side, I'm hearing stories about, like shortage of engineers, for example, and not enough. Even though we've got all this money coming in on the fiscal side to build all these facilities to create semiconductors, we don't have enough people who are trained to build for that certain particular technology. So certain pockets are still going to be a lot more demand, but broadly speaking, just because of slower growth, because of higher interest rates, we're going to start seeing that jobless rate inch a little bit higher.
Well, across this pond, we do have the ECB having a meeting on September 14th that is ahead of the Federal Reserve's decision on September 20th, but we are going to get some Eurozone inflation numbers on Thursday. How do you square away the issues when it comes to the inflation that Christine Lagarde is clearly trying to fight and indicated that at Jackson Hole last week versus what Fed Chair Jerome Powell is trying to do in the United States?
It's funny that you mentioned the ECB because if for the ECB, it's almost like a coin toss right now. If anything, right now, our official view, my official view is still that they're going to stay the course, just given that inflation has come down from those highs, given that all the hawks or most of the hawks have started to tone down their hawkishness, and the fact that China is slowing considerably as well. So I think that might be enough to put allow the ECB to sort of step aside a little bit. And she sort of hinted at that July meeting. However, the fact that inflation is still sticky, we got 3 new pieces of data overnight. Belgium, for example, it was like all over the map. Belgium CPI was relatively steady. German CPI edged a little bit lower, which is key, but it wasn't as low as consensus had expected. And in Spain, inflation rose for the second month in a row. So it's going to show that I don't think we're going to get a very clear signal from tomorrow's inflation report, and I think that will put the ECB still at play for September.
Well, most importantly, how are things in Canada?
Things are slowing. It's actually slowing a little bit more than we had, a little bit more actually than what's happening in the U.S. We're going to get some key data this week. On Friday, we're finally going to release our real GDP numbers for the second quarter, and we're looking for growth to slow to about a 1.2% annualized pace, which is about half of what we saw in Q1. We had a strong start to the year, but we've been dealing with a lot of wildfires, almost coast to coast. Labor strikes and all that's going to weigh on the second quarter. Of course, higher interest rates, and consumers here are a lot more susceptible, I guess, to rates than they are in the U.S. So I think we are going to see slower growth. It's just something, by the way, that the Bank of Canada is going to very much welcome because inflation is still too sticky. So as long as inflation or the economy continues to slow, which we're expecting in the second quarter, that will allow the Bank of Canada to stay also on hold for the rest of the year.
All right, Jennifer, thanks so much. We appreciate getting the global view, including our good friends to Northern Canada. Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets. That is Bank of Montreal, for those of us who remember back in the day. So we appreciate getting some thoughts there. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thank you, Paul. The first over-the-counter version of Narcan is hitting drugstore shelves in the next few weeks. Bloomberg's Erica Hershkowitz has more.
Walmart, Walgreens, and CVS will begin selling Narcan without a prescription. The medicine that rapidly reverses an opioid overdose will cost around $45 for 2 doses. Emergent Biosolutions, the makers of Narcan, has already begun shipping the nasal spray to pharmacies, grocery stores, and online retailers. It'll be available for consumers to purchase at thousands of U.S. pharmacies as early as next month.
Now, according to the CDC, more than 100,000 Americans died of drug overdoses in 2021. Shares of Emergent Biosolutions right now, they're up about 1%. And yesterday we told you how Best Buy is predicting the consumer electronics industry to pick up next year. But not everyone has that same optimistic outlook. Bloomberg's Steve Potisk explains.
Personal computer demand is not bouncing back as quickly as expected. That's according to the head of HP, as the computer maker reduced its full-year cash flow and profit outlook. PC sales have suffered a historic decline over the last year following a pandemic-era boom. HP says elevated inventory levels industry-wide are keeping PC prices down, and business customers are putting off purchases as they look to cut costs.
Now, shares of HP right now, they are down more than 7%. And merchants are about to pay more for the fees they get charged when customers use their credit cards. The Wall Street Journal reports Visa and MasterCard are planning to increase those fees starting in October and April. Right now, shares of Visa and MasterCard are higher. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. More data suggesting slower economic growth. That supports the idea that the Federal Reserve may not raise interest rates again. Private sector payrolls rising by 177,000 in August. That's according to the private payroll services provider ADP. Again, that was less than expected. The U.S. economy also grew at a somewhat slower 2.1% annual pace in the second quarter. So as a result, the major stock averages, they're in the green right now. They are higher. Treasury yields are lower. The two-year yield, 4 basis points lower at 4.85. The S&P 500 up 10 points, up 0.25%. We're at 45.08 on the index. The Dow Jones Industrial Average is up 70 points. That's a rise of 0.2%. And the Nasdaq 100, 27 points higher, up just about 0.2%. We've been covering the hurricane. Now there's a financial side to it for the investor perspective. Warren Buffett's Berkshire Hathaway made a bet that the reinsurance market in Florida would deliver huge premiums with minimal losses. So Berkshire Hathaway is exposed to about $15 billion of losses in the event of a major storm. So they're going to be watching very carefully about the insured losses from this particular storm. And I would venture to say it might not be as bad as expected, because where it made landfall, maybe a less populated area. So keep an eye on the reinsurance market as it pertains to Berkshire Hathaway.
Yeah,
anyway.
we're going to have Matt Palazzola on later today, senior analyst at Bloomberg Intelligence, who covers the insurance business, so we'll get the latest loss estimates from him.
All right, JT, we appreciate it as always. And Paul, we did get a few different data points on the housing side today. So we were just talking about earlier the pending home sales unexpectedly rising for a second month, but also we did see that mortgage applications also rose in the latest week. So I want to get straight to our next guest, Odetta Cushy, Deputy Chief Economist at First American, who's joining us on Zoom to discuss the latest data in the housing market. Thanks so much for joining us. Walk us through these latest data points and what this really tells us about the housing market at this point, because we do know that mortgage rates are at about a 2-decade high at this point.
That's right. So the recent increase in pending home sales, this is the second month in a row that there's been a modest increase in pending home sales, which is a leading indicator of future sales. That's really a testament to the strength of the demand side of the equation. There's still quite a bit of pent-up demand for homes, but insufficient supply to meet that demand. So some cautious optimism in the latest numbers. We saw this morning a weekly increase in purchase mortgage applications, although again, a very modest increase on a year-over-year basis. We're still quite low, both for mortgage applications and pending home sales, but you really see the strength of demand, even in such a high interest rate environment and such a low inventory environment.
What is the catalyst? Because typically the springtime is more of the boom there when you do see that when it comes to home sales, but this is a little bit later than that. Why is that?
Well, the pent-up demand, there's been a lot of multiple offer situations. And so, the folks that are losing out on those multiple offer situations are on the sidelines, ready to jump in when there is sort of a house out there that meets their needs and what they're looking for. And so maybe a little break from seasonality there.
So, Odetta, I'm looking at the bank rate, 30-year fixed mortgage, 7.53%. Is there a level where that needs to decline, where that might free up sellers to maybe say, all right, I can, in fact, part with my lower rate mortgage and maybe put my home on the market? Is there a break-even number out there that you think might be the magic number?
Well, that's the big question. Right now, more than 90% of existing homeowners are locked into rates below 6%. So certainly we need to see something below 7% to even see some movement there. There's not a lot of financial incentive for existing homeowners to drop those record low mortgage rates that they locked into at this point. So I think, well under 7%, probably below 6% to unlock some of that inventory.
We did see July pending sales rise the most in the West and also actually increase in the South, but probably not surprisingly, they did fall in the Northeast. What kind of dynamics are you seeing from a regional perspective at this point?
So the West that's your traditionally more expensive markets, and those are also the markets where we've seen the most severe price declines from the peak. And so in a higher mortgage rate environment, something needs to give. And in this instance, it has to be price. So the areas where we're seeing price adjust to the reality of higher mortgage rates, they're seeing a little bit more activity. So in this instance, it would be the West Coast, those traditionally more expensive markets.
So, Odetta, if there really aren't a lot of existing home sales in the market or available on the market, are the builders making up any of that kind of shortfall by just building more houses, new houses?
That's right. Builders are picking up market share. Traditionally, existing home inventory makes up about 90% of total inventory. These days, it's more like 70. Okay. So builders have really stepped up to build more homes. They're also offering incentives, rate buy downs, price declines to sort of help and entice buyers into the new home market.
Which builders have been kind of setting themselves apart the most in this, and which ones do you think are struggling more, depending on, I guess, which type of demographic you're trying to cater to?
It's really the bigger builders that have had a little bit more power to be able to do these rate buy downs. So I think in this market, it's more advantageous to be one of the big builders rather than the small builders that maybe don't have the ability to offer some of these incentives.
Odetta, one of the things that I hear from the home builders is, when they talk about their costs, and I don't even think about it, but that's the biggest cost, I guess, is just land. And some of these markets, everybody's flocking to Texas and Florida and places like that. Where do they get land, and can they get it on an affordable basis?
Lands, it's really multiple supply side headwinds and higher costs for builders. The cost of land certainly is higher, but of course they also are grappling with ongoing supply chain headwinds, right? Those aren't totally gone. And of course, the price of labor has gone up. Wages in the construction industry have gone up as well. And so costs all around for builders have gone up. And that's made it very difficult for them to build at that sort of starter home price tier, that entry-level price tier. And that's the level that we need at this point, because it's a lot of first-time home buyers out there that have been priced out of this market, and they're looking for that starter home price tier, and builders just aren't able to build at that price point because of higher costs.
So how do we end up fixing the inventory issue that clearly got exacerbated during the pandemic, but that was already an issue even coming out of the housing crisis?
There is some mitigating factors here on the existing home side. Of course, if rates fall, that will help to boost the market a bit. But we also have 42% of existing homeowners who don't have a mortgage on their home. They're free and clear on their home, and so they're sitting on a ton of equity. And so a lot of those homeowners can sort of be a mitigating factor amidst this rate lock-in period. They aren't financially disincentivized by higher mortgage rates because they don't have a mortgage. And so there's that aspect on the existing home side. On the new home side, we just need builders to continue to build more homes. And they do have quite a few challenges, whether it be regulatory challenges. And so anything that can be done to sort of ease some of those challenges for builders to allow them to build more homes where people are looking to buy.
How much of a concern is it for you when they can't potentially offer some of those price points to maybe younger buyers at this point?
Then we see that happening quite a bit. There's a lot of buyers that are now priced out of the existing home market. And of course, the new home market is traditionally been more expensive. It's been more expensive to buy a new home rather than an existing home on average. So a lot of those buyers are still on the sidelines and waiting for rates to come down, or they're looking at a lower price point home if they can find it in their market.
Also, what if people aren't willing to move out of their house if they already locked in, say, like a 2% mortgage rate? Or obviously we had rates at historic lows, which translated into mortgage rates. But what do you do with that dynamic if people aren't willing to move? And then obviously you would have home builders that need to build homes.
That's exactly the issue that we're facing in today's market. Existing home sales have been so depressed, mostly because an existing homeowner doesn't want to let go of that home. And that's likely a dynamic that we'll continue to see play out in the housing market over the next several years. I don't anticipate rates to go below 3% again. And so I think that will be constraining on the housing market for some time.
All right, so let's say I do the math with data and I can afford to pay a 7 handle on my mortgage. I go into a mortgage lender. Am I going to get that loan?
So credit standards have eased a bit since earlier this year. Certainly, credit availability has been generally low, but it will really depend on your borrower characteristics, right? On what kind of borrower that you are from the perspective of the lender. But they have eased a bit.
I think I'm a good credit. Would you loan to me?
I would.
Yeah, I figured I wouldn't. Like certain people in this room, I might not, but we'll have to see. Odetta Cushy, thank you so much for joining us. Odetta Cushy is the Deputy Chief Economist for First American. First American is a financial company. They provide title, settlement, and risk solutions for the real estate transactions, so they kind of get to see the whole space there. And again, the big issue is, I mean, people like Matt Miller, he bought the estate up in Westchester, and he's locked in like a 3% mortgage.
Right.
He says he's never leaving. He can't afford to leave.
So what do you do?
I don't know.
If you want that house, you can't get it.
I don't know. You got to build more. So again, I kind of got my mortgage with a 6 handle, which at the time I was very upset with. Now I'm a little less so now that I see we're at 7.5%, but I was hoping to refinance that thing with a 4 or 5 handle in the not too distant future. I don't know. The rates are going the wrong way.
I mean, these home builder stocks, once again, looking at the sub-industry group and the S&P 500, up 1.4% today. You look on an annual basis, up 40% year to date.
Nice. Yep. So yeah, when they make money, they know how to make money, and they can pass along the pricing increases, it seems like, pretty well. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Hurricane Idalia has made landfall on the Gulf Coast of Florida. It was a Cat 3 storm, bringing a new leadership test for 2024 GOP presidential hopeful in Florida, Governor Ron DeSantis. Jonathan Tamari is Congress reporter for Bloomberg Government and was a guest this morning on Bloomberg Daybreak.
It's going to be a major measure of Governor DeSantis's leadership there while he's in the middle of a presidential race. Hurricanes are nonpartisan events, right? It's not ideological. It's about showing that you can handle a major disaster and both comfort people and prepare people.
Bloomberg's Jonathan Tamari, as heard earlier this morning on Bloomberg Daybreak. You can hear more of that conversation on the Bloomberg Daybreak podcast. Download that wherever you get your podcasts. Now, New York City Mayor Eric Adams and New York Governor Kathy Hochul appear to be placing the blame on each other for the state's migrant crisis. Adams took Hochul to task publicly during a talk yesterday at NYU Law School.
Governor Hochul has been a partner on subway safety, on crime, on a host of things. But I think this issue, I think the governor's wrong. Every county in this state should be part of this.
Now, Hochul rejected that request last week, noting a 1981 agreement between the city and a homeless group only applies to New York City and not the other counties in the state. A newly filed lawsuit asks a judge to deem whether former President Donald Trump is eligible for the 2024 ballot in New Hampshire. The Boston Globe reports the lawsuit filed by Republican John Anthony Castro of Texas argues that the former president is ineligible to hold public office because he, quote, provided aid or comfort to the insurrectionists from the January 6th attack on the Capitol. Castro also filed a federal lawsuit in Florida in January, asking to have Trump disqualified, but that lawsuit was dismissed. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.